Welcome to the Motor Carrier Insurance Education Foundation's webinar, Interstate Motor Carriers and the Government. This webinar will be presented by Tommy Ruke and myself, Joe Huddlemeyer. Well, as you all know, insurance is a relationship business. The reason the relationships are so important is because clear and effective communication is critical to the process of quoting and binding business. It's important to fully understand what the client's operation is, so an accurate quote and policy can be issued. Again, trust is the key. Insurance companies need to trust the information coming from their agents and MGAs. Agents and MGAs need to trust the policy and the coverage that they're receiving from their insurance companies and trust that the claims will be paid. Conversely, agents and MGAs need to trust the company for a number of reasons, and trust is so important because you build it up over time, and distrust or poor relationships can be a result of a number of different things. Misrepresented information, which is very hard to get away from, lack of concern for other parties involved, poor quality or incomplete submissions, underwriters requiring additional information that is not relevant to the quote and slows down the process, or untimely or poorly managed claims.
Joe, in this situation, we hear often that, well, that agent sends an application in and they're lying, quote unquote, I didn't say that, about certain facts here. How do you backstop this as a seasoned underwriter, since you've done this most of your life, to make sure you're dealing with an agent, even an agent within an agency? There could be some differences in that, is there not?
Well, the first thing I'll say is underwriters have very long memories. And if you send in bad information, you misrepresent something on an account, whether intentionally or unintentionally, you will be forever in that underwriter's mind as having everything that you send in questioned. And in many cases, it'll go to the bottom of the pile.
And in today's marketplace, nothing can be hidden.
Nothing can be hidden with the amount of data that is out there for everybody to see.
And the more limited the marketplace is, the more centralized. So everybody talks to everybody that way.
Yeah, and Tommy, you brought up a point before that we've talked about many times. Every account isn't beautiful and perfect. And there are a number of issues that are going to pop up. And one of the things that you always say is, if you've got something that's ugly out there, you explain that to the underwriter up front.
And in that area, Joe, we're going to talk about this later, that also tells us that the worst thing a risk can do is to, particularly if it's a bad risk, is send it to multi-markets. The worst risk I ever had was a gasoline hauler, first bad, in Louisiana, second bad, with $1 million claim, third bad. They sent it to 22 markets. There's probably only 3 markets in the world that would consider writing a gasoline hauler in Louisiana. And so my suggestion is, those you got to get up close, maybe send flowers and liquor to the underwriters to make sure that they'll look at it, but then bring and say, what have they done to change? And so I think that's the responsibility of the agent also, Joe, to talk about how they can improve bad information or how can they explain it. And that's got to start in a process earlier than, I need a quote tomorrow morning.
Agreed, Tommy. And I think what people don't understand is, if an account like that is sent to 22 markets, then it shows a couple things. Number one, it shows that the agent really doesn't understand the marketplace if they're sending it to 22 markets, most of which would not even consider the risk. And the second thing it shows is that it's, to an underwriter, something that's being shotgunned like that, the opportunity to actually work with an account like that and bind an account and work through their problems and keep the account are slim. So you're going to get a declination in many cases just because it went to that number of markets.
And by the way, we're going to talk about CAB later in our program, but they also, if the people who are listening to us for the first time might not realize that every insurance market who accesses the public information through the third party finds out how many other entities are looking at that same information.
And that's one of the first things that we look at.
The first thing, and if you got too many, there's going to be some reasonable ones, because you expect people to update it and things like that. It's going to be a problem. We also look at incomplete operation. This is why in advanced underwriting, which we hope that you all will participate in. We're bringing them back this year as a part of the TRS designation process. We go through the checklist that you need to send. And so the more accurate information from backgrounds or other things, the better off that you get a good feel for the risk itself.
Yeah, the more information that we have, the more pertinent information that an underwriter has, the better the chance of you getting a good, accurate quote.
We mentioned the right price. How often do you get a quote? We would like a price within this parameter or what this happens. And first off, how often you get that, then how you pay attention to, and what happens sometimes they're so lowball that it causes you to run away, which is unrealistic.
Probably the marketplace is changing so much, and we're seeing prices going up on an annual basis. So it's really tough now for somebody to come in and say, I need a price of X dollars because the marketplace is changing so much. Now, if somebody does come in and lowball like you suggest, and you know that that's an unreasonable price for the risk in the marketplace, then you're just going to deny it up front and not even look at the account. You
mentioned in your earlier slide that it's key to know the insurance operation. So let's look at the next slide, Joe, and we'll talk about this. They need to understand to write the business how they operate. States with public information, it starts with that public information. Underwriters provide for the insurance has access to public information, so applications must match that information. So agents, you need to have access to that public information. You need to talk to your insurers, and if the insurer tells you something different, number of units, number of miles, address, email address, different than the public information, you need to correct the public information now, or at least find out which one is the right fact here, because underwriters don't rely on this. Agents need to understand and make sure the insured understands. Nothing can be hidden. Everybody knows everything. The public now knows everything. Misrepresentation and overlooking information will impair the ability to successfully obtain coverage, and at what price. Government requirements. This is what makes a motor carrier special. As you've heard me often say, always blame the government. That's always the easy thing to do. First off, a motor carrier, for-hire interstate motor carrier, which is the focus of the foundation and this program here today, must register with either the state or the federal government. As part of that registration process, they tell them who they are and something about their operation. In most cases, they're going to have to meet with financial responsibility. And that financial responsibility then will be the insurance carrier's obligation to meet that so they can use their operational rights. And then that information also is going to be a part of the application process, because I've always said, Joe, the first thing the underwriter does when they get the application is not look at the application, but look at the DOT number to see what the public information is. Then they look at the application to see if it matches. And so that becomes important. So the business that provides transportation, this is what we're talking about. That's the definition of motor carriers. A business that provides transportation. It might be their own property or somebody or for hire, which is what the focus of the information is. We start with intra-state. Intra-state operates in one state. They do not cross state lines. Key part, they do not cross state lines. So they must meet the registration and proof of financial responsibility imposed by that state, but only that state they operate in. If you're looking at doing this, most of the insurance carriers, Joe, who we're listening to here, are a part of ISO and can access ISO manuals because they get the rates and the rules involved in that. Retail agents can also do that. ISO, a long time, and not many underwriters, unfortunately, even know this, Joe, have a motor carrier digest that goes through the requirements of each state. And I'll just give you some examples here just for comparison. Where we have Illinois, for hire interstate truckers, they must have limits of, I think that's on the next page, Joe, of $750,000. The next state I looked at here is Florida. And Florida only requires $300,000, and $100,000 to $750,000 here, unless they're interstate for hire. There's a difference in Florida for a private or for hire. And then we go to another favorite state of ours, California, which requires a different form than the Form E that the state of Illinois requires. And California requires a BMC 65 and 67 on the cancellation. So that's the difference. And then lastly, we got our friend state, Texas, and they only require 500,000. So we've got states that require 750,000, a Form E. We have Florida that requires 300,000 and just an accord certificate. We've got California that requires a 750, but they require a different form. And we've got Texas that requires a form, but only requires 500,000. And so hopefully you will deal with the states, and that's what an underwriter relies on. And this is why insurance companies will underwrite to wholesalers, because the wholesalers should know the states they have authority to underwrite in and know which one of these things has to be done. Mm-hmm. And so we have that. Go back one slide, Joe. So the Form E is the most common form. I mentioned Florida and Texas are different, but everybody else requires a Form E. A Form E is a certificate of insurance sent to the state to show that they meet the requirements of that state. It would only be now for intrastate truckers. It would not be for interstate truckers for hire, even though they're domiciled in the state. We'll talk a few minutes about that, but this is the state unique part of it. Joe, in the old days, I used to file Form Es in a lot of states. Mm-hmm. Today it's very rare because there was an act in 2007 called the Safety Lube Act, which says if you're a for-hire interstate trucker and you've met the requirements at the federal level, then the state cannot impose a requirement on you for interstate operations, even though you go through that state. So now we don't do as many Form Es. Just rarely we get Form Es.
And it's really been a blessing for insurance companies that had to constantly make sure that they were filing the forms properly in every state, making sure they had the correct information. And then should the account cancel, then they had to make sure it was canceled in every state.
And that's the fair here. But let me tell you a story. A good friend of ours, the person who I would not be here if he wasn't an official guest, that I love to talk about him, unfortunately passed away a number of years ago, our friend Petey Gill. Mm-hmm. He tells a situation where he had a risk that was going to cross state lines, and they went into a favorite state that my granddaughter would go to that won the national football championship. I'm not going to talk about that state in a minute. That says you have to have $300,000 worth of limits. And Petey says, well, we got $1 million. State says, we have to have $300,000 worth of limit. And he called Ed Arndt, who was with ICC, says, Ed, will you straighten the state out? And Ed called the state, called Petey back, says, send him a certificate for $300,000. So nobody understood. They just looked at the form itself, and they stopped you if you didn't do it right. Or often it's, you get a call at midnight, it's a different name because they do a DBA in one state and another. So that took the problem away. We don't have as many truckers stopped anymore for not having the proper coverage at the state line, which used to be something that woke us up at midnight.
Oh, most definitely.
There is a situation now, if you file a Form E, you've got to have a Form F to cancel it. And this is going to talk, and later we're going to talk about it when we go into the last hours here about the insurance and what these filings mean. But this is the first indication here. If you look at this part that you can look at here in this 4F, the certificate of policies as proof of financial responsibility under provisions of the state motor carriers laws, our registered promulgations of any state commissions have jurisdiction with the state. And so it says in this situation that the insurance company, the limits of liability provided only that the insured agrees to reimburse the company for any payment made by the company that would not have been paid under the policy. So the point we have here, this is nothing but a surety bond that says if the motor carrier's policy doesn't pay or the motor carrier doesn't pay, whoever makes this Form E filing will have to satisfy the public in that state, in this case, later at the federal level. So, Joe, I hear often they call filings insurance coverage. It's not. Please, if you have anybody referring to a filing, later the federal or the state filing is coverage run from it. It's not coverage because anytime an insurance carrier has to pay when they insured did not buy the right coverage or the agent didn't offer the right coverage, then that would have to be, they would have to satisfy the public, but the insurance company can then seek reimbursement back against the insured for what had to be paid that wasn't covered under the policy. So this is the first time we look at that, but this is a very important point, even at the state level.
Yeah, and it's a difficult situation from a company side, because should there be no coverage in place for one reason or another, and the insurance company didn't cancel the filing that they were supposed to, and they were on for the amount of the filing limit for that claim, they have recourse to go against the motor carrier to collect that money. Whether there's actually money there or not is another question, and whether the insurance company wants to own trucks that are motor carrier, that's a question, but it was very difficult to collect after the fact.
Right. Let's look at this next one. We put this in here, Joe, just going back to showing how ridiculous this form is anymore. You never send more than one state or two states. Even truly large companies now, where before you'd have multi-state. I always said in my father's case, as most of you know, he was a trucker, east of the Mississippi. Had no idea what that meant, but this is how we did this. But
yeah, I mean, I could tell you cases where you'd have pretty much every state there, with the exception of Alaska and Hawaii.
I always like this one. We checked Texas, and Texas had a $100 fee. You send a form into Texas, and if your insured hasn't registered in Texas, they ran back and said, we can't accept it, but they kept the $100.
Yeah.
So you have to be careful about which ones. And I always said, find out the registration number of the state, because they would have to. You've got to realize, if the state requires your insured to have a Form E, they must first register with that state and find out why they need the Form E.
That's correct.
Let's go to the next slide, Joe.
Well, considerations here. To provide insurance to do business with an 18-wheeler operating in interstate commerce, you must be willing to know about the basic things: their operation, what their insurance needs are, requirements to meet the financial responsibility imposed by the federal government, and if they're operating within federal and state requirements.
You also need to maybe, I believe, help the trucker improve the CSA scores. This is a major consideration for underwriting, is the CSA scores. And so, Joe, even when I select what to send an app to, what will the CSA scores, and if they have any alerts, determine who would even look at it?
Well, I think if you go to individual company guidelines, I mean, a number of companies won't even consider a risk if there's 2 alerts or more than 2 alerts. And you look at the scores, and you look at the out of service numbers, and where they compare to their peer companies. And we get questions all the time from insureds saying, well, that information isn't accurate, it's not fair, any number of things. And it may not be accurate, it may not be fair, and it may be questioned by a number of different peoples, but it's the information that's out there. And it's the information that's going to be out there should there be a claim.
That's the key part here. So when you hear the CSA and the insured says, well, I haven't had any crashes, but my CSA score is high because of this or this or this, I got a bad driver at this. You got to understand, explain to them. The important part is, if you have that crash, these scores will come up in a court case. It makes us pay more. This is why it's so important. We're not saying these particular crashes. We're not saying you're a bad risk. We're saying how it's being used adversely by the court in a court situation. So one of the things that has been one of the foundations of the foundation, Joe, as you know, if you're going to write a for-hire motor carrier, you got to offer them more than a piece of policy, than the policy itself. And part of that is to help them with the CSA scores, explain it to them, help them figure out how to do better. And we'll talk more about that later, but that's a big part of this, because that's the manifestation. Are they living within the government regs and rules? And this is how it manifests itself in these scores.
Yeah, and it's one thing for us that underwrite motor carriers and those of you that are retail agents that are selling business to motor carriers, and we understand the different things that are out there, and we understand the comparisons. But in front of a jury, if you are not as safe as the next guy and your scores are high, we're talking about people that aren't familiar with how a motor carrier operates and doesn't understand the fact that they're operating 100,000 miles a year, and and everything that goes into it. And should there be a loss, whether the insured is at fault or not, those scores are going to be brought up in court and put in front of the jury.
And this leads to what we've been hearing too much about, that's nuclear verdicts. We don't have time to talk about it here, but this is one of the things that drive nuclear verdicts, because it takes away from what happened today, meaning what caused the accident, to the insured was a bad operation, and you need to get them off the road. The way to do that is make them pay money. Mm-hmm. And in fact, some of the legislation now talking about increasing the insurance limit. And part of that is, so then the underwriters who are putting these high dollars limits out there will make sure they're operating safe. And so it's kind of adverse usage of those kind of things, but this is the mentality both the jury has and fortunately the federal government has.
Agreed.
This is you.
Not you.
FMCA, Federal Motor Carrier Safety Administration, please don't use ICC. ICC went away in 1996. If your trucker has the ICC number inside, or an application that some carriers still have is the ICC filing. There's no such thing. ICC went away in 1996, January 1st, but that's a different point here. We deal with the Federal Motor Carrier Safety Administration and part of the federal DOT, FMCSA. You must do two things. You must register if you're for-hire interstate trucker, meaning if you cross state lines, now you're beyond the state jurisdiction, you're now in the federal jurisdiction. And you must meet the federal jurisdiction. And some insurers also then must meet financial responsibility. So we're going to separate those two. We're going to spend some time here to talk about the registration process. Later, we'll talk about the financial responsibility in hours later. So you obtain a DOT number. If your insurer does not have one now, it's an MCSA1. It's a portal. It's online. It's 22 some odd pages. It took me about 45 minutes to get through those, Joe. And there's some questions that even ask, like, who's your processing agent? Insurance. Most insurance companies might not know it, or agents don't know it, but clearly the insurer doesn't know what that is. So this is one area where some agents I know of are trying to help the insurer in becoming a service to help them walk through this to get a new DOT number. The US DOT number serves as a unique identifier, like your Social Security number, when collecting and monitoring the company's safety, meaning on-site or on-the-road inspections during it. So you have a compliance review, a crash happens, crash information, and safety. So this is what keys back to the public information on the on-road activities that leads to CSA scores, is that DOT number. And it's anyone operating under the DOT number, no matter who owns the vehicle. It's the DOT number on the side of the truck that caused the crash that all this record will be charged against.
And if you are submitting an application to an insurance company on a motor carrier and you don't provide the DOT number, the underwriter is going to understand right away that you really don't understand the business that you're trying to get a quote for.
And if you call me up and call you up, because I've heard you, and since we have to share in our office space here, could you tell me about this risk? The first thing I always ask them, what's the DOT number? Exactly. And I'll pull it up on the computer before I even start talking about things.
Yeah, and that's exactly what the underwriter does. That's exactly what the MGA does as soon as they get the risk. And the first thing they're going to look at is their DOT number and their scores. So
let's look at who must have a DOT number. This is federal. States can differ. This is federal. We'll talk about states in a few minutes. Anyone, any business, using a vehicle for commercial purposes, meaning hauling own goods or goods of others, that cross state lines with a unit that has a GVW of 10,001 pounds. Folks, that's 6 wheels. That's a dually pickup truck, or a pickup truck with a trailer behind it will have to have a federal DOT number. Anyone has to do that. Does this include private as well as foreign? Absolutely. My son-in-law got stopped for going from South Carolina to Georgia because he didn't have a DOT number a couple of years ago. And I hadn't told him that yet, but they stopped it. Fortunately, this gave him a warning ticket. And then he decided or told him he also didn't have a driver's qualified because the driver had not passed the physical. And by the way, where's your fire extinguisher? And where's your live plume? So once you cross state lines, folks, you get into federal, even in a dually. He had an F500 Ford, a dually, you had this problem. So it's not the 18-wheelers here, it's everything here. And they might need financial responsibility depending on if they're hauling something hazardous or not. We'll talk about that later, if you're a private carrier. And in this case, since I know my son-in-law has a skid loader, and I know that they across the state lines that skid loader, and that skid loader has diesel fuel in it, he then would have to have $1 million in MCS 9 on his policy. That's a little different. Later we'll talk about it. So they must pay a DOT, must obtain the DOT number, but they also must pay a fee. People forget this, into the Uniform Carrier Registration System. That's what completes the DOT number, is pay that fee. And that fee is an annual fee.
Public information, again, we talked about this briefly earlier. We're going to talk about it again. And the DOT number for interstate and for some intrastate. Tommy touched on it. He touched on the fact that you're not necessarily talking about an 18-wheeler. You're talking about anything over 10,000 pounds, and quite a few vehicles that you see on the road that you would consider a small truck are over 10,000 pounds.
Yeah, we kind of emphasize that again on the next page, Joe, just to make sure that we're there. It's again, the federal government requires commercial motor vehicles, DOT, 10,000 dB or larger, not just 18-wheelers, for hire, private, interstate. When items are being transported across state lines, either by the unit being transported to others, they will meet financial responsibility, and then they must pay a fee in uniform carrier registration. This is what makes them operate, quote, legally in interstate commerce. These are the states. And I always have this comment that these states are lazy because they just stop the federal race. So anybody operating in any one of these states also must obtain a federal DOT number. And could be a difference. Florida's a difference. Some states like Florida and others, instead of 10,001 GVW, have gone to 26,001 GVW. We'll find later the 26,001 GVW is a bigger truck, 6 tires, but bigger truck tires, not the pickup tires, but 1,020 tires. And the reason they've done that is to get rid of the long maintenance in the pickup trucks here at a state level, not federal. You cross state lines, it can be different. Now you cross state lines, but if you don't cross state lines, some of these states do not require to get a federal DOT number or a DOT number until the vehicle is 26,000 GVW larger. That tracks some of the driver's requirements here, so you need to be careful here. But the point here is that if there's interstate commerce or if they're intrastate in one of these states, they must send them information into the federal government and obtain a DOT number, and that information will be in the website Safer. So this is the website address, right, Joe? But the question here, Safer. But it's not one website, it's a portal to many websites. So this is what most people don't understand.
You're absolutely right, Tommy.
So why don't you take us into it? We got a picture here of this of the website itself. First off, what Safer stands for? Safety and Fitness Electronic Records. That's what safety stands for. It's a system. And it keeps you updated where your insured can access it by having their own PIN number. And then they talk about getting a PIN number if they need it here and welcome part of it here. And this is safety fitness. There's a lot of data here. So if you look at the next slide, Joe, we can see all the stuff that can be done here. There's a few of these that people ignore and don't look at. The main ones we're going to look at is in that middle column, snapshot, analysis and information. That's A&I, and that will be anybody with a DOT number. And license and insurance for people with only federal MC numbers. However, on the right-hand side, this is FMCA's homepage. This is the important part here because that'll tell you about all the legislation being proposed. That'll tell you about the drug clearinghouse. That's how you access the medical providers. It'll tell you any regulations here. And so often your insured says, why do I need to do that? Well, you can copy here. Or later we're even going to copy things out of that shows the information that you might have to for financial responsibility. Data queue. If your insured is challenging any inspection because of the wrong number or the officer miscuts, they can have the data queue situation put in that part of it. So this is a lot of things that we don't look at. We only commonly look at the snapshot. The other thing that here and later we're going to talk about using a third-party provider for some of this. Well, the third-party provider won't give you access. They're only going to talk about the first 3 items there. And it's nice and often go into the website. as one of the things that we found, that I found, is that the FMCSA had the wrong MCS 90 on the website. And I actually got them corrected to the right one. And so I don't know who else could read the fine print of it to realize it was the wrong one. And they reacted to it. It had to do with the cancellation provision we'll talk about later. But that's what can. So you need to look at more than this. And I recommend you going and looking at the FMCS website to look at information, then download regs and rules if there's any questions about these kind of things. Talk about what's public conveyance and the guidelines and things here. So this is something that, as an agent, you need to be aware of all that. But now let's just go to the snapshot. The snapshot here is where we access it. And we put 3 ways to access somebody: US DOT number, the MC number, the name. Caution, don't just put the name. And if you just put a name, you don't want to put Tom Rook's Trucking Inc. because I might be an LLC. You just want to put Tom Rook, and then you get half a dozen. You don't want the whole name, because if everything there doesn't match somebody else, you don't get the name, the one. So this is one thing that you can do in prospecting here. You run down the road or you look in the yellow pages and you see a company that you might want to look at, you can put their information here and find out about it. On the way into the office this morning, Joe, because I want to use it for a later presentation, I saw a truck with 6 tires and a trailer behind it with a federal DOT number. So I slowed down and took a picture of the side of the truck. I'm going here and look at that DOT number to find out who they are for other details that we're going to use in a presentation later. But if I'm going to solicit their business, I can find this information out. So this is the key here. And I don't know of any other business that you can look at the side of the power unit and then go back and find all the information we're going to share with you guys in a few minutes about this. But this is the part. Strong recommendation, start with the DOT number. You can do the other 2, but be careful if you do that. So we just picked the DOT number here at random, and you type it in. And then what you have here with the DOT value here, and then you can get the inspections and reports and these kind of things. The SMS results, that's the CSA information, and that'll be a link we'll go to later. And license insurance will be the insurance requirements they have. That will only be people with MC numbers. So let's look at a typical report, Joe. This is, you got the carrier name, authorized for property. Now, when you hear the one authorized for property, you know that they have an MC number, because authorized meaning they have authority in this case. The other thing is you got their contact information, address information, and then you got the DOT number and their MC number. You also can look down here and find out when their DOT number was updated. Now, folks, I realize this is out of date here because we didn't redo a new number here, but it has to be updated every 2 years. If not, they're going to be inactive here. And so as an underwriter, what are the couple things you look at here that's important to you that you want to make sure the insurance on the application matches?
Well, number one, the first thing you're going to look at is the number of power units. And if you have an application that shows 4 power units and the safer shows 9, you know you've got a potential issue and you've got a number of questions to ask. Then you look at the drivers, and
that's not on that page. That's later.
Well, the number of drivers here.
No, not on this page. It's later. Don't go later. We'll go drivers later.
Okay.
Excuse me, number of drivers. I'm sorry. Excuse me. I'm sorry.
Tommy, I've looked at so doggone many in my career.
I'm apologizing. Drivers.
And we've got 9 units and 10 drivers, and that's not all that unusual. What would be unusual is if we had 9 units and 4 drivers, or 9 units and 24 drivers. And finally, you look at the mileage, the average miles per year, or the miles per year. You got 9 units doing 640,000 miles. In my mind, you got somebody that's probably struggling on the financial side, or he's probably operating on a local basis.
Or they could have added units because that year could have been the year before, and now they had changed the units, but did not change the miles.
Agreed.
And this becomes a problem with that. And so this is the important part. So you're matching drivers, units, and miles. Exactly. 1 driver, 1 truck, and about 100,000 miles is where you start in your mind.
Exactly.
And anything different doesn't mean it's right or wrong. In explanation that you would need. In this case, I would tell you that the owner has a CDL, but he only drives occasionally. Therefore, that's why we have one extra driver.
And that makes sense, and that's logical, and that's something that if the agent that's presenting it puts that in the application, it just takes one of the questions out.
Right, one reason to respond back.
Exactly. And you're right with the miles, and that's one of the reasons why it's really important to get mileage history and unit history, because like you said, I mean, my first conclusion was the guy has more units than he should for the miles he's operating. You came back and said, that's correct, Joe, but what if he just grew the units at the end of the last year, or just put them on the beginning of this year?
Or the economy, last year he could have done more local mile delivery and not over the road that he did before, or she did before.
Exactly. I'm gonna turn to the next page, Tommy.
You're on. I'll try to read it right. All right, authorized for hire. These are other categories. We'll talk about, summarize this later. You have exempt for hire, then they will only have a DOT number and not an MC number. If they're private hauler, they will still have a DOT number, but not an MC number, and the rest of the stuff here. And then you got intrastate. Now, the one I always like, Joe, is cargo. You know, general commodities, fresh produce, beverages. That makes sense, but I've seen somebody checking with 5 or 6 trucks about a half a dozen things. Who looks at this? Who pays attention to this?
Everybody, especially the cargo underwriter.
Everybody who's an insurance provider, but nobody else.
Exactly. Right.
Nobody else cares about this.
Nope.
Just the insurance provider. So you got to have more of the general freight, but you got to be more definitive. You don't want to ask them, what do you hope to haul? What have you hauled? But what do you intend to haul in the next year?
Well, I mean, I look at this, and general freight, we try not to even classify. Fresh produce, yeah, that's it. Is it refrigerated? Is it non-refrigerated? You know, he hasn't checked refrigerated food, so it's probably not a reefer produce. But then I see beverages, and first question that comes to my mind, is it alcoholic beverages? Is it soft drinks? Is it milk? Is it orange juice? What are the beverages being hauled? And I think on the application, you just need to be more specific. But like you said, Tommy, I've seen operations where with 3 or 4 units where they type that they haul refrigerated food,
building materials,
you know,
beverages,
and livestock.
Right, and livestock. Yeah, it's 4 different kinds of training.
Yeah, exactly.
So realize that to them, the shippers are not going to give them a load because they didn't check it. That's not important. The important part here is the underwriters need to have something close to this to start with, to make sure that the cargo coverages matches what they're actually hauling.
That's exactly right.
Then we go and we find out how many units are out of service or not, and we compare it with the national averages. This has been the old way they did it. These national averages here are wrong, but FMCSA has corrected the national averages now to be more current than we have here. But always, like everybody asks here, is IEP. Mm-hmm. Anybody know what IEP stands for?
I guarantee you the answer is going to be no.
The answer is intermodal equipment providers. Mm-hmm. This is if you're an intermodal equipment provider, if the equipment gets inspected, it gets inspected against the owner of the equipment, not the motor carrier. That's the unique thing here. That's just a quiz that you have here. But you do look at the out of service ratios, do you not, Joe?
Most definitely, because you know that if there's a claim, it's going to be brought up in court.
Well, no, not claim. This is out of service. So if you know if they're operating out of service and they're shut down because, and the reason they would be shut down is because they exceeded basically the hours of service or they got poor maintenance problems.
Well, but Tommy, you know, from an underwriting standpoint, you know, when you start looking at these at a national average and your out of service numbers are higher, then it's going to be sold to the jury that you're worse than the average.
I don't disagree with that. That's part of it here. And then you look at crashes. There are 3 types of crashes. Somebody got killed, somebody was injured and had to have treatment away from the crash site, and 1 or more tows the vehicles. And it shows tows. Joe, there's a number of carriers, insurance carriers with maybe even 9 units that do not require loss runs. Some short of that. But I've always said that if you show a crash here, you want an explanation, even though you're not requiring loss runs.
You're gonna want to know when the crash was, what type of crash it was. I mean, this case, guy could have run off the road.
Single deal,
Exactly.
or had a flat tire or something like that. And you need to know that this doesn't always match up to loss runs.
Almost always it does not.
Loss runs are when we pay something.
Mhm.
This is when you had a DOT crash. If the truck ran off the road and had to be towed away, but nobody had to pay anything, it would not be obviously a liability cash. It might even be a physical damage situation. They could have an injury and the injured person drove their car to the hospital and sued later, which wouldn't show up here, but would be in the loss runs.
Definitely.
So you need to realize this is the DOT recordable. Later, we'll talk about the drug testing tied to these accidents once we get later into the program too, post-accident drug testing. Then you have the safety, safety fitness determination. Joe, we have so many now that are unrated. About 87% with people MC numbers unrated. This one we got inspected in 2017 was satisfactory, but that has no idea if they're satisfactory today. Now they had another inspection again in 2020 with a compliance review that would lead to another inspection. But you're going to have 4 types of scores here. You're going to have satisfactory, unsatisfactory, conditional, or unrated. Joe, the last time we checked with people with MC numbers, would you believe less than 11% of people with MC numbers out of 250,000 have satisfactory?
Yes, and I think if you look at the numbers closely, you'll find out that the majority are unrated.
No, 87% are unrated.
Yeah.
Conditional is about 4%, and for higher interstate, those people with MC numbers have nobody unsatisfactory because they can't get a load. They had the last time I checked was 111 out of 250,000 people with MC numbers here because they can't get the loads. Mm-hmm. Now, for you who listen to us who also write private carriers, that might be a little different because you're going to find some private carriers might be unsatisfactory because they don't have to go to the shipper to get loads. And so this is why the statistics that we try to quote you at the FMCSA, Motor Carriers Insurance Education Foundation, is people with MC numbers, because those are people that are for-hire interstate motor carriers, not just everybody with a DOT number. Difference is there's about 550,000 people with DOT numbers and about 250,000 people with MC numbers, and somewhere around 30 or 40,000 with DOT numbers interstate without an MC number. Those are the numbers that we have here. Let's see what it is. So Joe, applying for a motor carrier is unique. This is the public information you use.
Yeah, it's exactly right. Motor carrier applies for DOT number. The new application is an MCSA1, and you do it online. It includes information about the business. The information must be updated when a change in the operation occurs. It must be updated in any case every 2 years.
This is something that's unique in this area, is that they update this information every 2 years. If you ever see an insured that's inactive, the reason they're inactive is they have not updated. And you update it based on the last 2 digits of the DOT number. The segment from the end is the year, even or odd, and the end number is the month, with January being 1, October being 0, and nobody's required to update in November, December. Now, the rules say that you have to update every time there's a change in exposure. Mm-hmm. And so if you change units and all, you should update more often. You have to update within that cycle or you're inactive. There's also a second way you can be inactive, and that's not paying a uniform carrier registration fee. And so the point I'm making in this, Joe, those are 2 mechanical things. How many insurers forget to update? They're inactive. But think about a crash happening when your insurer is inactive. And how are you going to justify that in court to say they weren't supposed to be on the highway? Every aspect of it's something mechanical, had nothing to do with their operation. They weren't on the highway, and now they're illegally running, and they would not have been out there to kill our people out there. This is why it's so important to track this. This is also something that actually, as I showed you, I have a DOT number. As I showed Joe the other day, I got information that I had not updated. I'm inactive. I'm not looking at it now, and it shows about the fines or not. For you who are looking at risks to write, you can actually get a list of people in your territory who have not updated in the last 22 months and send them a letter and say, if you don't update, you're going to be inactive. And so that would be a marketing tool in this area, because that's a very important part, is inactive in this. We just went through the public information because, and the key part of it is that when the insured obtains a federal DOT number, because they cross state lines and units 10,001 GVW, they make application to the federal government. For a private carrier who also crosses state lines, they must have a DOT number also. This is people where we got underwriters who write commercial auto who have no idea that they got this public information that you just went through. For hire, the market that you're specialized in, the foundation knows this all the time. But now when they make that application, they tell us who they are, they tell us the contact information, they tell us how many units they have. Later we'll show you even who owns the units. They tell you how many drivers they have, they tell you the cargo they're hauling, all this other important information that you have now that's out where? In the public. And who's using it? Underwriters, claims people, lawyers, everything else. This is why we say nothing can be hidden. And so now let's talk about converting that public information, because now as an agent, my objective is to get you to write a risk. We already talked about, I got to tell the truth. I got to tell the good, bad, and ugly. Things are not so ugly. And for people who don't understand what's not so ugly, we gave you a couple of examples, and not necessarily here in this case is ugly. We'll talk about ugly ones later. But the drivers didn't match the numbers of units they had. So you're going to think in your mind is, well, if they got more drivers, they're hiding a unit. Or if they don't have enough drivers for all the units they're showing, where they're going to get the next driver. I mean, that's just the mentality of people like yourselves. No disrespect in that area. And so you can clear those things up. Just like the cargo is kind of mixed up. I don't know really what their operation is, because there is a difference hauling the beverages, dry van, drop and hook, versus fruit, which might have loading, unloading, is it perishable or not. One might be subject to the FSMS, the Food Modernization Act. One might not. And so these are the things that the underwriter needs to be, the agent needs to be aware of when they talk to the insured about the importance to be as accurate as possible. And then I want to remind you is that they have to update it every 2 years, but my suggestion is about 60 days out before renewal, or when you're asked quoted, to go to the insured, sit down, talk about their operation, and then you need to have as an agent in your hand this instant report, safer report, either through a third-party provider we'll talk about later, or actually what we just went through, so you can show to the insured where there's some discrepancies or some areas that need to be cleared up, and say, go ahead with your PIN number and straighten this out now, because when the underwriter looks at it, they'll match that up. And they usually need what, about 2 weeks to get all that stuff?
About that,
Yeah, every month it's going to change no matter what, because that's when the CSA scores change every month. So now, Joe, let's walk through how the insured now gets the information from the agent, the agent gets information from the insured. We showed what the insured's told the government, but now the agent is walking up there and saying, I want to make an application on your behalf. So let's look now, welcome back to slide 39.
Well, number one, the agent's got to obtain the information for the quote from the insured. And if you go back a number of years ago, the retail agent would be sitting across the desk from his insured motor carrier. With COVID today, there's much less sitting across the desk and a whole lot more information that gets passed online. Or in a phone call, or in some form of communication. So the agent obtains the information from the insured, and like Tommy said, does it match the information that the government has out there for all the world to see? And if it doesn't, why doesn't it match? And is the insured changing it? If the operation has changed, explain the differences. Explain on the application, explain on a cover note, explain so that the underwriter is not seeing a flag pop up right away.
And the one that we just looked at, we gave you an example. 9 units, 64,000 miles, just doesn't float.
Nope.
So either because of the pandemic, we had to park some units, and so we didn't want to sell them because we knew we were going to get back. We're doing more local delivery, or I added, I had 2 trucks or 3 trucks less in that year I reported versus the year that we're dealing with now, because I didn't update my units, but I didn't update my miles. That's the
exactly.
And by the way, I did make a note here about the update. The only thing the motor carrier has to update, not to be inactive, is the years the miles represented. Everything else can stay the same. So that's the one thing that triggers. And sometimes you'll see VM that they'll be inactive because of VMTs, vehicle miles traveled. That's what wasn't updated in the year. So that's the only thing they had to update. I forgot to talk about. That's the only thing here. But you don't usually look at safer, did you? You use a shortcut to it.
No, I think if you look at most of the underwriters out there, whether they be on the company side or the MGA side, they either use CAB or carrier software. They're the 2 main providers of disseminating that public information, sorting it out, putting it in a form that's easy for an underwriter to follow, and basically putting as many answers out there to the questions the underwriters are going to have that one could possibly think of.
And one location might go on 3 or 4 websites here.
Exactly.
I always thought, Joe, that as an agent, one thing that I wanted is the same information you got, because I need to know what you're looking at and see if there's any anomalies that I need to explain away like we just went through here. So one of the questions here is, does the agent have the same information? It is available to them if they're willing to pay the price. And that's one thing that we talk about when you've joined the foundation or you're just starting in this path to write trucks, right, for hire and state motor carriers. You've got to invest not only in time to learn about it, but you need to make some investment in software or things to get the information that you need to be effective in this marketplace.
Yeah, the safer information is pretty basic. When you start going to CAB and carrier software, then you're basically going to the next level.
So let's figure this out. Let's ask the next question on the next page. Well, in a minute, we'll talk about this. Let's look at this. I'm going to put it here because I need to read a little closer here. These are things you need to look at. Authorized for hire, that means they have an MC number. Exempt for hire means they have a DOT number, not MC number. So they can still operate, they just can't haul processed goods interstate commerce. The example I've used, for you have not heard this, I must say it every time I teach, I'm obligated to say it. My father's business was hauling pickles for plastic food. And when he was hauling the cucumbers, he was an exempt hauler and had no need for MC number and no proof of financial responsibility. But once they opened a plant in Millsboro, Delaware,
They got processed.
and he started processing it, now he couldn't haul it without getting a special additional authority, and that's also an MC number. So some of you are going to write pickle haulers or livestock or corn, grain, interstate commerce, watermelons out of Florida, this kind of stuff, that would not have an MC number. Just a DOT number. That doesn't mean they can't operate. They still have authority to operate process goods. So that's the key part. Here, we're talking about private passenger, private migrant, U.S. mail, federal government, local, and then the other thing. So the point here is that if you can be authorized or not, and that's the point, the 2 that we want to, and these are the classifications in the operations that you have that's important. What's CAB mean?
CAB stands for Central Analysis Bureau.
That's what I asked her. How far they go back?
When I started underwriting business in transportation business in 1979, they were still around. They were around then.
You remember Ira did a program that you were on with me in Philly a while ago before they transitioned. And they started, and this is the important part here, they started providing information to underwriters based on things they got from the federal government. And early on, the most important thing they got was the financial information.
Exactly.
Because pre-1996, the IST Act, they had to file financial statements to justify the rates they charged their customers. And they started capturing those things and doing scores and this kind of stuff. Then they evolved into this tremendous software company that aggregates all that public information and gives it to a format that you can use on a regular basis to save you time and effort. This is the part here. We'll talk a little bit about that, but this is where it comes from. It's public information that they buy from the government, they aggregate and provide to you. So this information reflects what?
Who, what the operation is, the financial responsibility requirements, on-road activities, and the inspection results.
That's a little bit about everybody, who they are. And have you ever seen it, Joe, where the name insured requesting a policy is different than the DOT number?
Quite often.
Quite often.
Quite often.
And we got to explain this part of it too, particularly if you have to make a financial responsibility filing. That makes a big difference on that part, which we'll talk about in the last hours of our program. So this, and the white means that we just went through. Are you exempt or not?
Mm-hmm.
Do you have a DOT number or not? Operations, we'll talk about the radius, the type of equipment they have and this kind of stuff. Financial responsibility will only be people with MC numbers.
Exactly.
That will be shown on the federal level. On-road activities and inspection, that's the out of service that we talk about. If they're stopped because their maintenance problems has to be repaired before they can move again, or the driver has to rest before he or she can go again because they violated hours of service. And then the inspection results. The inspection results are what is shown the CSA scores. But there's also, for you who don't understand this, also for the smaller motor carrier who writes the units on a specified auto basis. What the inspection report also shows is a serial number of the vehicle being inspected. And every underwriter is going to look at the past inspections, what, Joe, 3 months, 4 months back, to make sure every unit has been inspected is on the application.
Or in the policy.
Which on the application to be on the policy, is what I'm saying in this part. And if they're not, you need to explain they sold it, they got rid of it, and with bill of sales or something, you go out of that question. And then during the policy term, they pay, or they have an arrangement with CAB that reports any vehicle that is newly inspected, meaning that and then you check it to see if it's on the policy or not. If it's not, you got problems.
Mm-hmm.
And so this is how the insurance carriers are monitoring, are we insuring all the vehicles insured using on the DOT number? And the most frequent ones that might be left out are ones that are owned by owner operators. That's what makes this business unique, is the use of the owner operators.
Yeah, and in many cases, we'll look at an insured and you'll get an application in with 6 units. And then you go and you check the inspections, and there are a dozen completely different units than the 6 units that they've got listed on the application.
And that mainly because of owner operators. I mean,
exactly.
Own units we usually know about.
Yep.
We get physical damage on it. We get notification for proof of coverage to provide a license plate. Owner operators come on and off the policy. And when we do other classes, Joe, and you've heard us do this as consideration, that's what we say makes the motor carrier unique, is the use of owner operators.
Exactly.
No other business uses owner operators like the for-hire trucker, because no other business says, I'm going to put my name on the side of your truck and I'm going to be responsible for everything you do, as long as my name's on the side of your truck.
Mm-hmm.
People use owner operators all the time to haul gravel for a road contractor or asphalt, to haul beverages for a beer company for hire and things like that, but not like the trucking industry. This is what makes the trucker unique part of it here. We talk about all this public information and these third-party providers, but I think we just need to point here. You can do direct, but there you got to go to 3 or 4 websites. You got to analyze it. So the 2 entities that are third-party providers that you have to pay for: Central Analysis Bureau. This is the contact information. Gene Gardner is the head of that, and Carrier Software, for Greg Lack, is the head of that part of it here. They give the same. They buy the same information and give the same information in slightly different formats. But there is something that's important between the two. We mentioned CAB started by providing underwriting information to underwriters. Carrier Software started by giving information to motor carriers to improve their safety. So their focus a lot is on safety improvement, CSA scores and CSA improvement, and tracking the insurance DOT numbers and things like that, where Carrier Software is more used for underwriting purposes. CAB, excuse me, is more used. Our point here is, guys, these 2, and again, full disclosure, are members of the foundation, are good friends of ours to help us get through this. you got to have one or the other. You need to see which one makes economic sense to you and which one fulfills what you're trying to do with your insurers. Just underwriting or trying to help them improve and do better. Would you not? And you can tell an agent who's not accessing information, can you not?
Most definitely. And you know, operating as an MGA for a number of years, many of our companies allowed us to use their number to access CAB. The companies that didn't allow us to use their information to access CAB, we bought the information ourselves. We had our own contract because we didn't want to be blindsided by going to submitting an account to an insurance company and then having them question things that we weren't aware of. And it's always best to know the answers to the questions and actually provide the answers to the questions before they get asked.
And they access the same information, they pay the government from it, they just have different views of it, but it's the same information.
Exactly.
On this way, again, a little more emphasis on carrier software, on the safety CSA part. For carriers, for CAB, it's more interested on the underwriting, the scores, how many units, a million carriers, and this kind of stuff. So it's just the focus different here. I always like this question, Joe. I ask people purposes for an application. We ask this consideration. I talk about, or they come back and talk to me about, well, you know, all this and all this. I said, no, the bottom line is to make Joe want to write the risk, to give you a warm, fuzzy feeling.
Exactly.
And so to be successful, you got to have a sound, to get excited about providing a sound quotation that will be successful. This is what I got to encourage Joe to do, this part. And so what we're talking about, the information's got to match. You got to give them more details. If there's any problem area, answer them up front, anticipate your questions beforehand.
Answer all the questions.
Answer all the questions on the application. And then again, getting back to what we talked about before. If you know a half a dozen underwriters are going to quote it, all of a sudden, you know that your chances are not as
good as being successful.
As good. So it goes on the bottom of your list and you don't pay any attention to it.
Exactly.
And this is the thing here is, you know, I tell the story, Joe, and fortunately we're too old to do this and we're not going back to our previous lives. But how many times when we were very young could we tell the same person that we loved them? Or how many people could we tell we loved them? 2 or 3 is about all I can stretch here, right? You didn't know, I know that part. Anyway, my point here is, I tell you, how many other underwriters like you can I tell you, I really want you to work on this, and I really love you to do that, and you believe me. Mm-hmm. You keep track of the hit ratios, and this is going to turn them off, okay?
Yeah, and one other thing I want to say with respects to the application, never use an Accord application. Right. If you use an Accord application, then basically what you're telling the insurance company or the MGA that you don't underwrite trucks and you don't understand trucks.
Every carrier you have that we deal with has basically, well, there's 3 ways. One is you got some electronic, like our friends out of Cleveland and Century and others that have the application process. Most of them have paper, usually have a small fleet, which is 1 to 5 unit application, then, a small risk, 1 to 5 power units, and then a more complete one that's 5 or more, 10 or more, pick that number here. They usually have a couple. You want to come. But if I don't have, we'll use examples of members here. If I don't have a Carolina Casualty, they'll step to Northland or Canal or Lancer one way. Now, as long as they're in their peer group, they just won't accept in the court.
Yeah, I mean, most, if not all of the trucking applications have the same questions, maybe in a different order, maybe ask a little bit differently, but they all have the same basic information. So, you know, providing a nationwide app to Northland or vice versa is not going to present a problem, because basically what you're doing, as Tommy said, you're just giving enough information so that I feel good about quoting the account.
Right, and you want everything. If there's things like this that you also need to note, because you don't want to get it, you want Joe's attention to it when they get it. If you're missing something, and sometimes you might not have current loss runs. But you need to let Joe know you don't have them and you're getting them. And the other thing, Joe, that I always say, point out here, what drove me crazy is young, inexperienced underwriters.
Mhm.
And they have a tendency sometimes to ask for more information
Than they
that,
ever use.
that they will not change their mind.
Mhm.
So if we have people listen to us who are underwriters, and again, a lot of them are not licensed, so they don't need to see, so they might not be listening to us, but when we deal with face-to-face or advanced underwriting, we encourage it. When you ask for more information from the retail agent, think about what will be the answer that you would get that would change your mind. If nothing will change your mind, don't ask for it. And tell the agent what. If the loss runs need to be updated, we need for our file, but if that loss has settled at no less than that, no more than that or less than that, then, or stay the same, then we're okay. But I just need it for my file. That's the kind of stuff that you need to take care of, right? To know to go forward with that.
Well, I worked with a guy for years that needed to know the answer to every question. And we missed out on a lot of accounts because he'd get some answers, he'd ask some more questions, he'd get those answers, he'd ask some more questions, he'd get some more answers, and he'd keep asking questions, trying to find out every little detail about an account, when none of those details were going to make a difference whether the account was writable or not. And all it did for the most part was turn off the agents and said, I don't need this. I've got another market that's going to do it based on the information I provided, and I don't need to keep answering questions.
Right, and so underwriters can hurt themselves by that, by being overkill. So think about that part. But that doesn't mean agents don't need to give all the information necessary. So I got to find out what information you want, Joe, in a format you want beforehand, and that's a communication I have to start with.
And that goes back to what we talked about earlier, trust, and understanding, and going the trust between a retail agent and a company or an MGA, and knowing that, hey, this is the information the guy needs, and I'm going to get it, and understanding why he wants it and what it's for.
In a format he understands, in a model that is in his sweet zone, if not why it's not.
Exactly.
This is part. And so the last comment here, because we're going to move on to another subject, drivers in a minute. The better the insurance provider understands the exposure, the more accurate the underwriting pricing will be.
Exactly.
So you start with this information and safer, better access to carrier software, CAB. You get the information from the insured, and if the insured doesn't tell you and what they've already told the government and the public, then you update that.
Exactly.
So that then when you get as an underwriter, you can track it, and then you send the application in, not an Accord, but you send one that's a truck specialty application for for-hire trucking on the application that they need, so it matches there, and you answer all the questions, and you don't shotgun. This is what we're saying here to help with these, to help be successful, that part of it. There is one quirk, though, that when you deal, that you need to realize, different from dealing with a wholesaler Joe was and directly for the company. Sometimes once you say, Joe, I'll write it and give me a quote line about it, but now you're going to bind it with a canal, and I sent you a nationwide EMS app. You're now going to require me to have another app.
Exactly.
And you want to make sure the second app the insured has assigned matches information on the first app, because that first app was sent usually 6 weeks earlier. And so that's a burden that you're going to have to deal with too as a retail agent, because you do check that back. And being a type A personality, guess who never sends that second app back?
Well, I will say that probably 35% of the time, from the time you quote it to the time you bind it, there's been changes in drivers, changes in units, sometimes even changes in commodities. If somebody gets a contract to haul something they weren't hauling previously, and a lot of times the account has to be requoted, because if nothing else, number of units change.
Yeah, it's a big, and again, you got to do that thing. Be careful. Again, quoting my friend Petey, he told us an example, and wish he was in front of us to tell it again, about between the time he got the quote and the time he was bound, a couple of weeks, they had a total loss. And he went through the trauma, do I tell the underwriter that? Because I got a quote, I got permission to bind. but he knew that the underwriter sooner or later was going to find out about it. So he told the underwriter and said, I know you might want to change this, but here's what happened. Here's the facts. It's going to be a policy limit loss. And the underwriter, because they trusted PD, said, don't worry about it. We'll honor our quote. Some people would have heartburn on that, but that's the kind of agent, Joe, and that's the kind of reputation you got to have to be successful in this process. That part. The key part, no matter how you boil it down, once you get all this information, is who's driving the commercial auto that we're insuring. Period. I don't care how you get. I don't care how sophisticated you are. I don't care. But that's the bottom line. Later, CSA, you're gonna find the number one predictor of crashes is the driver fitness, and we've been saying that for years. Driver fitness. So it's the driver behind the wheel whose actions we defend and whose damages we pay caused by the negative action. So we start by the driver. So the driver selection here, it'll affect their safety rating.
Right.
Inspections, driver, do they do the VBR, the walk around the driver vehicle maintenance report beforehand? Do they honor the hours of service? Do they check the tires? Do they stay within the speed limits? All that kind of stuff is going to do that part of it. The safety rating, which some of you are listening to this, and again, Joe, if I'm wrong, you need to tell me this, but a lot of times you pay more attention on the safety rating than actually some losses here, because we are getting paid to have losses.
Exactly.
And it depends on what the facts are, but that's you'll tolerate some explanation for losses, but you're not going to tolerate somebody who violates hours of service regulation. That's because something they can correct. That part. Also, again, to obtain insurance. That's the key part. Every quote that you give is based on the driver profile that the risk tells you. Either small risk, the actual drivers, or larger fleets, the history of the type of drivers they hire, period. So your quote's dependent on that. Your price is dependent on that. Also, a lot of times to determine loads will depend on the driver, not only on the relationship the customer has with the driver and how they know to set the thermostat for cargo. So the driver hiring, who's behind the wheel, is important. So there's two factors behind the wheel. Does it meet the insurer's ability to find them? Does it meet the underwriters? But more important to start with, does it meet the FMCSA regs and rules of the drivers behind the wheel? Because if they violate the regs and rules, they're going to have a problem to start with, no matter what the other two have. FMCSA, bad drivers must be stopped from driving commercial motor vehicles. Folks, those are part. And when CSA first came out, that was a part of discussion. I've had lawyers say that we're going to get rid of 20% of our drivers here. Well, they didn't do that. They went by and made it more information available so the motor carrier can choose what drivers to drive, but they didn't weed anybody out. They're not going to shut a driver down unless there's just been a continuous violation of the regs and rules. So selection of the new driver. The motor carrier is not hiring bad drivers. That's the key part that we have here. And you monitor the current drivers. Every time you have a loss, Joe, that driver's MVR becomes a part of it here. And was the driver reported to or not? And you keep track of those kind of things. This is going to be the thing that's going to sway some of these kind of things. So the bottom line is the federal government's concerned about who drives the commercial motor vehicle, and the insurance industry is concerned about who drives the motor vehicle. The acceptance and the pricing is based on that driver that they select to put behind the wheel. So let's look at the things that we talk about when we screen our onboard drivers. You hear the term onboard the drivers. We've been using MVRs for 30 years. The primary evaluation, the trucking area hire or not. Joe and I go back, and this is for young people, and if you get tired of us telling old stories, we apologize, but they were all funny stories. For you who did not know that, prior to Motor Carriers Act of 1986, which was the CDLs were effective April 1st, 1994, we used to ask the driver, let me have a copy of your good driver's license. Because they had 3 or 4. Did they not? How often did you find that?
Quite often.
Quite often. You know, I had one in the post office box and things like that. So, and that was all based on MVRs. That's all really we had. MVRs show the drivers not adhering to state driving regs, mainly speed, following too close, and these kind of things. Because of that status in the industry, the issuance and discussions around MVRs were the focus point of all driver screening and risk assessment. You started there. Now, what we went back, and this is the additional information the federal government gave for the motor carriers to make a more wise decision based on federal regulations, not just state speeding laws or road laws, is they came up with a pre-employment screening program, the PSP. And this is valuable information for the motor carrier when they select the drivers they're going to hire. This is the point here. So what does it show? Every time the truck gets stopped, the results of that for an inspection, the results of that inspection goes into two databases. The first database is the carrier SMS, the carrier safety measurement, and that's what the CSA scores on things we talk about, and we'll talk more about that later. The other one, though, goes into the driver's SMS, the driver's safety measurement system. And that's the information on roadside activities, the results of the inspections, whose DOT number they got inspected under, and any violations of regs and rules or clean violations here. The big difference here is that the CSA goes back 2 years, drivers go back 3 years, and drivers go back crashes 5 years, where you don't account for anything against the motor carrier itself over 2 years. Big difference here. And so it's for pre-employment only. That's the only people who can hire. It's as you onboard it as a part of the qualification here. And it cannot be shared with any other insurance. It cannot be shared with insurance company. This is only for drivers. So what the underwriters are doing is asking your insured, do they use the PSP program to screen the drivers? Statistically show that once you get over 5 units until you get about 30, you reduce crashes about 10%, safety scores about 20%. And why is that number? Well, 1 to 5, I'm hiring my brother, my son-in-law, my next door neighbor. 5 to 25, I don't have a back room to screen them. Over 25, those big fleets always do a better job here. So this is where it's important here. Do you use them? And then you say, how do you factor in the PSP with your hiring standard? This is something agents, if you now suggest you're insured to go start using PSP, you got to realize they got to also rewrite all their hiring criteria, because most of it's based on MVRs. Now you've got to base it on roadside activities too, including discipline. So they got to change their screening process and their disciplining process. So it's not that easy part of it here. And so it can be used to screen new CDL drivers by the potential employer here. Now, what the insurance industry can do is ask the insured on the application, most of them are now, are you using it and how do you use it? And then when you send the loss prevention people by, that loss prevention person said, let me look at your driver qualification files, and then they can look, they can't take copies of it, but they can look at their PSP scores to see if they're living within that, here's how we're going to screen drivers. So it's an important factor that is very valuable in that area. So, has an insured provider required for driver's exception explained to the retail agent and insured? Are MVRs required? Do you require MVRs on everybody, Joe?
Depending on the size of risk, for the most part, if you're talking at even up to maybe 50 drivers, you might want 50 MVRs. But once you get past that, then you're looking for a random sample. And what most companies will do is they'll ask for the company's driver guidelines, and then they'll advise the insured which files they want to look at. Again, random sample, whatever the percentage might be, and make sure that the guidelines that the insured says that they have posted are being followed.
And so and all the time from loss prevention people, they come and check the file to make sure that. And this is the part you have to, and this is one of the tragic part of the turnover in this industry for large fleets is so great that we're more worried about how they're hiring drivers, the actual driver behind the seat. Once you get over, what, 5 or 6 vehicles, 10 vehicles, this is where this part.
And on the small risks, you generally want all the information pre-binding, so that you can verify the information that the insurance told you. It's like, these are our guidelines, and we don't hire anybody within this age. There's so many violations, and then if you find out that they've got 3 or 4 drivers and they say, oh, well, I got 20 drivers, but only 3 or 4 of them are not acceptable, that's not a risk you want to write.
Yeah, that's part of it. There's another consideration we have in this thing, Joe, and that is what we talk about. We use the term turnover. And I don't like that term, but that's what everybody hears. The turnover pre-COVID was in the range of 97, 98% at the 100% level. That means if I had 50 trucks, I'd have to hire 50 drivers every year. But our concern is more retention than turnover. We're worried about how many drivers have been insured over a year, because I think that's the benchmark. You remember the old Northland study that was done, I guess, 15 years ago?
Yeah, maybe 20.
They studied it and found that 80% of all the crashes they had were with drivers that had been with insured less than a year.
Yep.
And you think about why? Strange territory, strange equipment, different routes, different dispatchers, different pressure. It makes all that, it makes all the sense. So one of the key considerations that you need as a retail agent to help the insured is help them reduce their turnover. Do you have any idea on statistics, Joe, how much it costs to onboard a new driver?
It costs a lot of money to onboard a new driver. I don't know what the number is today, but I mean, it used to be pretty dramatic. And what you see, and close to 100% turnover in any other business in the world would be, oh my gosh, what's going on? 100% turnover, I mean, Tommy used 50 as an example. Say you've got 5 units and you've got 4 drivers that have been with you for 10 years, and that one unit, you got 4 or 5 new drivers. So it looks like you've got 100% turnover, and really it's not. That goes where Tommy's discussion about retention versus turnover.
It costs the bare minimum $2,500 to $3,000 to process it. If you factor advertisement, if you screen them, and you're only going to hire 1 out of 10 you screen, and you factor why you don't have a driver, the truck's stopped, that number can go to $8,000, $9,000. And so what's your insured doing to keep the drivers there, to keep this churning here? And this is a real point that we have here. Second thing I've been using is PSP. You need to find out if they are. The application is going to ask that. Then you want to verify an inspection how they're using them, and they're using it within the qualification. So let's look at what the FMCA requires. If the unit is 26,000 GVW larger, that is a truck with 6 truck tires, 26,000 GVW or larger, or hauling anything hazardous, something smaller than all for-hire, private, intrastate, or interstate trucks. The driver must have a commercial driver's license, a commercial driver's license. When this first came out, Joe, I was on the First Baptist Church downtown here, insurance committee, and we had a bus. And I reminded them, as of April 1st, 1994, everybody who was qualified had the bus had to have a CDL, which required them to be drug tested. We sold the bus. But that's what we're talking about. We forget, it's not like truck driver, it's your mechanic test driving the truck. It's your church volunteer. It's not when there's passenger or if you're paid to it, it's when somebody's sitting inside that seat driving on a public highway must meet this qualification. So some of you who listen to us might not ride 400 state truckers, but you might ride a garage. You might ride a private carrier who's not in the arena that we're talking about. They're all subject to this part of it here. And so this is the point here. So it's everybody. The employer or the driver who operates a commercial motor vehicle must make sure the driver has proper driver's license or could be fined or be held liable. And so for you who can write, where it says held liable, put a dollar sign there. Because if the driver, no matter what the driver did, had a crash, and they didn't, and your insurer did not meet at least the minimum requirement for them to drive that vehicle, you're gonna pay more in court. This is the danger we have for underwriters. That downside. It might not be they're gonna have a crash or not. It might make no difference if they don't do that. It's a problem. What is a commercial motor vehicle? Vehicles having a gross vehicle weight 26,000 pounds or larger. That's a truck with 6 truck tires or more. Vehicles having a gross combination weight. That's a tractor trailer 26,000 GVW or larger. Passenger vehicles designed to have more than 15 seats or 16 or more, depending on how you want to count it. And vehicles that have to be placard, meaning they're hauling 1,000 pounds or 3,500 pounds of a hazardous material that's to be placard. The only exception here, or actually I show one that's practical. There's 2 other ones. The 2 other ones I don't show here is emergency response for a volunteer fire department. And the one that I think needs one, and that's the Winnebago driver. All right. Those are, if you're hauling your own goods in your own truck, you don't have to, that part. Agriculture is one. If they're hauling their own goods in their own trucks, meaning the driver or who owns it, within a 150-mile radius of the farm, the driver does not have to have a CDL. That's the only exception here. But I don't even like that exception, Joe. How many people with a large truck, 26,000 GVW larger, are not going to hold their neighbor's goods every now and then? You know, you got a big farm not to haul somebody else's goods during the year. You know, pick a little fertilizer up for me while you're down there. Yeah. So that bothers me about that, but that's the exception here. Now what we have is the combination of EOC violations and violations of screening the driver. I must ask the date of birth. It has to be on the application because you have to be more than 21. If I was hiring Joe as my bookkeeper, I cannot ask his date of birth. No. But if I hire Joe as a CDL driver on the application, I have to ask him that. And so every insurer in this industry has to have 2 sets of applications or amendment, one for non-CDL drivers and one for CDL drivers. You must have last 3 years of employment, and you must verify that last 3 years of employment. This is what PSP does. PSP shows you the vehicles they've been inspected under for the last 3 years. So you can see whose DOT number and how they were inspected. Then I must verify, were you employed that long? Did you have any accident or did you have any drug testing?
Well, and that's one of the things that if you have PSP standards and you get PSP on all of your new hires, then you're really short-stopping some potential problems, because prior to that, you could have a driver that said, I've been working for ABC Trucking, and whether they did or not, or whether they worked the entire time for ABC Trucking or not, you know, they may have worked for 2 months for ABC Trucking and then worked someplace else and got fired, right, or had drug issues. And you know, they say, I work for ABC. They don't say the second motor carrier that they were operating for, and you hired the guy not knowing that there are issues. PSP will kind of prevent that from happening in the future.
It's the backstop. You still have to verify that kind of stuff. And any error, if you go back to the previous employer, they must respond, and any errors they try to correct. All right, Joe, next slide. You need to have a current CDL to qualify to drive the vehicle, with or without a hazmat endorsement, with or without air brake endorsement. You must have an MVR no older than a year in the employment file, and they must have a DOT physical results. This has changed. This is one of the major changes here. Before, the motor carrier had to make sure they had a DOT physical. You have to have a DOT physical update every 2 years, but now your driver has to do the physical, but then take the physical to the Department of Motor Vehicles and have the Department of Motor Vehicles verify that they passed the physical, and that will be now showing up on the MVRs. This is the major difference in the last 3 years about the physical part. But because in Florida, we don't up our driver's license but every 10 years, but I'd have to get my physical updated every 2 years. So the motor carrier still needs to track their drivers when the physicals had to be redone to make sure that they're doing it.
Well, and the comment number 2, where they're required to have an MVR no older than 1 year. Most insurance companies, if they're looking to write your coverage, are going to want an MVR within the last 90 days. So anyway, so you're basically getting an MVR for multiple reasons.
And that's a point here is though 2 things. There's 2 types of MVRs. There's an employment MVR that the truck drivers have, and there's insurance MVR that we access.
Mm-hmm.
We as insurance industry, and hear me, agent, cannot send MVRs to their insurance.
Agreed.
They cannot send. Can they get the MVR from the insurer?
Yes.
There's nothing that prohibits that as far as the law is concerned. Some of the MVR providers say you can't because they want to charge somebody for the second one and they want honor, but they cannot do that. It's because of the Fair Credit Reporting Act. It's why we cannot, as an industry, provide it. We can pay for it, but have it sent directly to the insurer, and then we can get it back from the insurer. That's the point we have here. So please don't provide MVRs to your insurance in that part. This is something that we have a lot of controversy, particularly when this first came out. So you have a pre-employment drug test. Also, this has changed. This is the new. You have to drug test the driver before they can start driving. They have to be subject to random drug tests. And now it's 50% of the pool, where before it was only 25%. That's because the last time they did a census here, there were more failures than met the threshold to increase again. And that's mainly because of the marijuana differences that's happened in the last 3 years. Strong suggestion. If your insured has less than 100 power units, you want to outsource this. And even if you have 100 power units, you might want to outsource it anyway. You need to go to a provider here, because if I have one truck, I've got a random drug test myself.
Mm-hmm.
And that can't be done. So I need to be in a third-party provider to do that. And when you choose a third-party provider, you must also make sure they have a footprint as large as where your insured travels, because there is post-crash drug testing requirements that need to be done at the crash site wherever it happens by this same third-party provider to make sure you meet the requirements here. So this happened. But now there is, as of January 6, 2020, there's a drug clearinghouse. And that procedure is all CDL drivers must register. Employees of CDL holders must check with the clearinghouse before they can confirm hiring. So when I look at Joe, I've got to find out and go to clearinghouse to see if he has cleared. If he has not cleared, then I cannot hire him. If he has failed to report a drug test, I cannot hire him. That's the big part here. And so all failed to refuse drug tests must be reported, both by the motor carrier and the drug testing facility. Has to be reported here. And anyone who failed drug test cannot drive until they have done through the rehab process. And it can be done in a couple, 3 months. But my question you hear, if you failed a drug test, even though you went through rehab, how many insurance companies are going to allow me to hire you?
Probably none.
Yeah. And the last count, the last full year, there were about 55,000 failed drug tests. And there's one other thing that just came up, is that they also have to have a limited drug test by every driver. And the reason they do that is their concern is this driver might have worked for somebody else in that period of time and failed a test there that you don't know about. And since all you did with the drug test them is when you first employed them, then they do a limited one every year to make sure none of those drivers had a violation that you did not know about during the year.
And this is going to become more of an issue with more of the states making marijuana legal.
It's going to be a big question.
And, how is that going to affect driver hiring? I mean, we're already seeing some issues in certain parts of the country now as a result of, initially it was medical marijuana, and now it's legal marijuana.
Yeah. And right now marijuana is not, and that's the one that stays in your system the longest. And there's also some here, there's a lot of stuff. We'll keep track as the Motor Carriers Insurance Education Foundation on this update. This is a big thing. We had a couple webinars about it, but this is a major concern that way. No, I put that slide up here because we just finished talking about the underwriting requirements and drivers, but there's a lot of noise now about drivers. And I thought before we get into coverage and liability and filings and all that, that maybe we'll spend a couple minutes here just kind of wrapping up that last section, since we're up against the time, about the public here. Is there a driver shortage?
Yes, there is. There definitely is, and it appears to be getting worse, Tommy.
You think the COVID impact, where some people got out of the business and they're not going to get back in the truck anymore, or the fear that they're going to bring it back to their family, things like that, has taken a toll on the drivers?
I think it has, and I think with COVID and everything going on with it, a lot of drivers that were spending time away from home want to be home more often, don't want to go as far from home. So yes, I do think that's having some serious considerations.
Well, there's a point you just brought up here, and that's away from home. When we talk, and we don't have time in this session about Thomas vehicles and all that kind of stuff, there is definitely more driver jobs for local deliveries than there were before. So maybe now the driver shortage is the over road, meaning that they go beyond a 300-mile radius, so they have to stay out overnight. That might be the focus here, but it is a concern we have here. We've talked to a number of people. You've been on the webinar we put together, and one thing they did say is that dollars do make a difference.
Yeah, and lately we've seen numbers where driver pay scales are going up to $80,000 and plus.
Yeah, and the part of it, and we did a relationship with the driver, increased wages before, and made a comment that didn't impact the cash flow as much because fuel cost was coming down too. So they were saving money on the fuel, that they were able to pay the drivers more without bottom line. But right now, last time I looked at the pump, the fuel cost is going up.
Yeah, which is definitely going to affect things going forward.
And it's going to be a real pinch on that part of it here. So that's the concern, and we got to watch that because we don't want the motor carrier to substitute quantity for quality.
Exactly.
And that would be our concern there. A lot of things age. As you know, the drivers 55 years old represent half of all the driver force out there, less than 10%, and I'm quoting rough numbers, or less than 30. We had a discussion, I'm out of school, so now what do? I can't be an over-road truck driver until I'm 21. But the anomaly of that is I can drive an 18-wheeler in Florida at 18 from Key West to Pensacola, which is 600 miles, but I can't go from Tallahassee to Thomasville, Georgia, Tallahassee, Florida, Thomasville, Georgia, unless I'm 21, and that's only 30 miles. So something's got to give. That SMART Act that's in Congress right now is talking about letting 18-year-olds, well, there's already one talking about letting younger military trained people who can prove that they drove commercial vehicles in the military to be able to get an overroad interstate CDL at less than 21 years of age. As an underwriter, and again, I'm going to ask you to think forward, not backwards here. What are we going to do coupled with driver shortage, and can we introduce some younger drivers under certain conditions into the workforce?
I think that going forward, Tommy, we're going to have to see a shift. Now, my whole career, most insurance companies did not want to bring anybody on board less than 25 years of age.
Sure.
And you'd get an exception maybe down to 23 where they had, 4 years driving experience doing something other than long haul over the road.
Often I've said, you got to be a truck driver, got to be born 23 years of age, but you can't become one. You're right.
And as a result, we lose a lot of potential drivers coming out of school because they can't drive. They can't legally drive over the road. So, you get an 18, 19-year-old coming out of school and they're looking for a job and looking for a career. Forget about looking for a job. And rather than being able to get into trucking, they'll go into construction or something else because they can't operate an 18-wheeler.
And now with 2 or 3 years of age, now they got more than an entry pay, hopefully, if they're worthwhile in the job. You mentioned school. I forgot to bring this on driver shortage. One of the things that's backing up driver shortage is the driver training schools have not been able to function because of COVID. So we don't have as many graduates into the system, even though we might not want to insure them right out of driver training school, but that's better than not having any training. I'm not going to ask you to react to that, but at least that's part of it here. But that's also COVID has impacted driver training schools, so we don't have any graduates now to back up.
And from what I hear, the federal government is backed up with respects to licensing.
Right.
So, that's kind of a double hit there, Tommy.
So that would be a part. The last thing is affecting drivers. If you remember about 3 years ago when they went to the medical providers, we lost a few drivers because of the medical conditions. Now that there's more scrutiny done by the people who are on the registry. The last thing that we talked about it earlier when we talked about how you screen a driver is the clearinghouse. And we mentioned this 55,000 people failed and this kind of stuff. This is going to impact drivers also, is it not? And unfortunately, even when we put down the marijuana and COBAs, that's going to be some of the younger ones, and that's got to be addressed somewhere.
Yeah, I think we'll see some kind of adjustment with respects to marijuana, if nothing else, because so many states are legalizing it, and it looks like it's going to be more over the next couple of years.
Well, I'm waiting for a judge to consider that as part of the American Disabilities Act, that's a reasonable accommodation to have the pain there. But again, don't quote me anytime on this thing, but this is going to come down. The problem with the marijuana, as I understand it, and never smoked in my life, so I'm not making disclaimers here, is that you can't measure the degree of impairment, and there's difference in the amount of impairment drugs within the different grades. And so until they come up with some way to measure it, it's going to be tough.
Yeah, it's not like you can check the blood alcohol level. And even at that, Tommy, even if you pass an acceptable drug alcohol level, would you want to be on the road with somebody that's barely below what's legally drunk driving an 18-wheeler?
It's tough enough to drive an 18-wheeler with all that part of it here. And technology might help some. All the stuff you have in your car to drive, stop and all that might help drivers and the attention they're paying and all that. So that might be a corollary to have some younger, less experienced, if the truck is equipped with all this driver assistance equipment on it, that might help a little bit.
I think so. I think that's going to be the way of the future. We touch on autonomous vehicles. I think we're years away, maybe not as many as I would think, but I think before we see an impact from autonomous vehicles, I think we're years away. But I think if you look at the different things that can be put into a commercial truck at not too excessive costs, where you've got the lane change deviation and the following too close, and even
crash mediation,
even with the cameras where you can basically watch a driver and help educate him as to what he's doing wrong, whether it be cell phone usage or inattention.
Yeah, I've seen some of them that even give them a warning if they notice that they're looking down or not paying attention. So that will help some ways. All right, that's drivers. The next thing we have from an underwriting consideration that we might have, Joe, that you have to deal with is the miles that's traveled. So let's look at the next slide. How many miles does the provider rate? I have always said, and I'd like your reaction as an underwriter, your premium is based on X number of miles, typically 100,000 miles a year. And if they get more than that, then there's more exposure than you're getting paid for. Less than that's more favorable, maybe not a one-to-one correlation, depending on where they are. So you have in your mind, do you not, for every unit or for every X miles, you need a base premium?
Yeah, definitely. And, the chart that we have up now, the mileage neutral values per radius group, is pretty much what we go by. Now, there are different, depending on exactly what the load is and what you're doing, there are deviations, but this is pretty much a benchmark of what people use going forward with respects to mileage. And, when we were underwriting a risk, you look at the number of units and you look at the miles, and if there's anywhere between 100,000 on a over the road risk, 100 to 120, you felt pretty comfortable with getting the with the exposure meeting the price you're getting for the risk. You know, where a flag would pop up is if you had 10 units and the mileage was, you know, was in excess of that number, where, you know, then the first question is, how many units are you really running?
Right, so you still have to, and so back to our earlier discussion, when you submit that as an agent, it's very important to come to the average miles per unit, and the better math you do as an agent to send to you, the better you'll understand it. And if there's any anomalies like that, why? Obviously, if you get 170,000 miles, you got team drivers.
Exactly.
And this creates a different situation than less than that. So those are the things that we would have to figure. But so miles is a real rate-driven factor here.
It's probably the easiest thing, the easiest way to judge your exposure is using mileage.
So what's consideration? Let's kind of wrap it up on this page here, Joe, this area that we have the miles and symbols and all that. Let's speak a few minutes about this part of it.
Yeah, you know, a lot of smaller policies, smaller trucking operations are rated on specified auto basis, where you have to list the auto and you are getting a premium charge per auto. Other methods of basing your rate are mileage and receipts. We just talked about mileage some, and it's something that traditionally we've kept track of via IFTA reports that we require and really should be provided with the submission at least 4 quarters prior to what you're writing. And then receipts, gross revenue is also, and there it's harder to judge on gross revenue for a number of reasons. Again, it could be the way it's reported. You know, when you go back 15, 20 years, if somebody was doing 100, you know, $1 million in revenue, you know, for 10 units, you know, you thought, okay, you're going to get by. Now
you got to have about 220,000 per year. But back revenue base, I have been in many disputes where I became a third party in the dispute. Is fuel tax revenue or not?
Yep.
Is brokerage revenue or not? And this becomes debatable. Clearly, if you have apples going in and apples coming out, everything's okay. But a lot of our insurers, and unfortunately some agents who are going back again, you don't have all the right information that we talked about in the first hour, tries to throw in everything they can as revenue going in to get a rate per mile, a revenue per dollar, excuse me, not mile, but a rate per revenue. And then at audit time, they want to extract all that kind of stuff. This becomes a real
because it deflates the rate, and nobody wants that. But the problem is, in most insurance policies, all of the exact details of what is considered gross receipts is not really explained,
defined, right?
And defined exactly.
So we have minimums to guarantee, and you have to worry that as a regulation in case like COVID, when things shut down, we had to go renegotiate some of these minimums out there that we have involved. So you got to be aware of that, because minimum earned. I don't like a minimum monthly earned. I understand a monthly payment you have, but you want to kind of even up at the end of the year based on what you project here.
Yeah, and I think most companies there are 1 or 2 companies out there that do have a minimum monthly earned, but for the most part, you know, because transactions are seasonal, and because you've got certain times of the year, depending on the commodity that you're hauling, that you're going to have greater revenue than you do at other times of the year, whether it be slowing down in the summer or slowing down in the winter, you know, building up for Christmas and the holidays, or building up for the construction industry, and a lot is tied into the economy itself.
And so audits are concerned, and so agents, you need to be involved in this audit, because at the end of the time, to make sure the numbers are right. Talk a little bit more about IFTAs then, will you, Joe, please?
Well, basically, motor carriers have to report their fuel tax their miles for fuel tax to the states, and as a result, they have to complete a report every quarter and provide it. And as a result, it should give the underwriter a real good feel of the mileage driven and the mileage driven per state, because the report breaks out for tax purposes, the mileage by state. And it's very good from an underwriting standpoint because it will verify some of the information you get in SAFER, which is a plus. It'll give the underwriter a good idea of where the miles are being driven. Is it being driven in high exposure states, or is it being driven in low exposure states? And
yeah, and when you talk about exposure, first off, IFTA stands for International Fuel Tax Agreement, and it recognizes that a significant part of all the gas, or even our personal cars, is the state fees that are attached to the federal tax fees. And so that can vary. South Carolina is one of the lowest ones. So I visit my grandkids, I make sure I fill up in South Carolina before I drop the car off in Atlanta airport, even though I'm right at the border, because that can make as much as 10 miles, 10 cents a gallon more. So the problem is, if you buy too much in a low state and you spend times in states that have a higher, you haven't paid for the road. So it's a leveling up depending on where you're driving and your average per mile so every state gets their fair compensation, or at least a formula that figures out the compensation for the miles they drive in their state, even though you didn't buy fuel in that state. So it's a leveling up in here. Now, we have a new thing called electronic log devices. And what I found out on IFTAs, it's supposed to be the actual miles, Joe, but IFTAs typically reported by use RAM and now moving and storage guide, that's one of the things, or by zip codes. Now the ELD also will report IFTA miles. There's probably a 10% difference, because the ELDs will be actual miles.
yeah, because it's GPS tied, and it'll give you miles from the minute you drive into that state to the minute you leave that state.
Where you might not have this, so you need to be careful, both underwriters and agents out here, particularly the premium based on miles. How now, if you're reporting on IFTAs, which is the exact miles, the zip code miles, or ELDs, which would be the exact miles. Again, the bottom line is the more miles, the more exposure. So this is what you're trying to drill down in, as well as where they're going.
Exactly. Inspections and crashes.
That's the SMS stands for Safety Measurement Systems. You got CAB carrier, Central Analysis Bureau and Carrier Software. Here's what we're trying to do is the radius, Joe, because that's important where they are. As you know, that those two entities capture where inspections are done and where crashes are, and will give people a radius the motor carrier operates in, and based on the inspections and the miles. And most underwriters kind of factor that radius in, do they not?
Yeah, I mean, that's one of the first things that underwriters look at on the report, just to verify whether the territory driven on the application matches with where the inspections have been.
And this lets you know, again, under agents here, if things look anomalies, it could be anomalies for two reasons. Because what CAB does in carrier software is they use the address on the 150 form. And you can have a truckload carrier and the driver never comes to the terminal.
Mm-hmm.
They could still be within the 200 miles of their house, yet they could be 400 miles away from the terminal, depending on what the routes are in those areas. So that becomes a problem here that the underwriter, that the agent needs to know if there's things outside that to report back. Also, if they have multi-terminals, I think both CAB and carrier software will run radiuses based on the terminals other than 150. But again, that would have to be information that would be asked by the retail agent to those entities or to the underwriter to rerun the radiuses based on the terminals they might have. But that could be.
Yeah, we had a risk once that was based in Omaha, Nebraska, and they operated within 500 miles of Omaha, Nebraska. Yet, when you looked at the radius on the report, it showed, mileage pretty much countrywide. Well, there was they had a contract with a shipper in Southern North Carolina, and they hired 3 or 4 owner-operators to operate out of their house, and it totally skewed the numbers because they still were operating a 300-mile radius, but it was 300-mile radius of basically Charlotte, North Carolina. When you look at Omaha, Nebraska to Charlotte, it's a lot longer than 300 miles.
I had the same situation. I was riding work comp for a flower hauler out of Miami, hauling out of the port. Then I got to Memphis and found they had a lot of miles in California. And, well, California's pretty narrow. You're going to get a lot of miles. I understand dropping off and coming back. So, oh, by the way, we have a terminal in California. So here I had a work top situation, and IFTA showed us things. So IFTA will tell you things like that, plus a CAB here in these locations. You know, we did 10 agents, please don't push these miles. You cannot drive with one driver more than 130,000 miles a year.
And that's pushing it.
And that's pushing it. That's not taking in holidays and no maintenance or anything like that. So underwriters understand that. If anything you got to report over 115,000 miles a year, the underwriters want some explanation. How in the world can you do that? And we also talked briefly on the slide before, Joe, about the revenue. Here, you know, I'm looking at the access report that a trucker spends on a road truck would be about $165,000 a year is their hard cost. That's just keep them on the highway, not buildings, not you know, bad debt, not things like that. So you've got to generate between 200 and 220,000 miles if you're going 100,000 miles a year to stay on the highway. So you might, I've seen some, Joe, with good routes. I looked at one risk for having, again, some input on a court case that they got they were generating about 320,000 miles a year, but they had a real sweetheart route, consistent route every day, you know, drop off and appreciate. So you could push the envelope above that. My concern is if they're not generating at least 200, 220, they're going out of business without it.
Probably. And if you have an example like you had, Tommy, where they're generating 300 plus, you know, give a reason, you know, give the reason why that number is out of line with what you normally see. You know, and underwriters know that, you know, you got specialty haulers, they're going to be generating more revenue per unit. Tankers, you know, they're going to be generating more. Reefer is on the high side, dry box van is on the low side, flatbed for the most part is on the low side unless you're doing oversized, overweight, and then you got different exposures. So, you know, again, underwriters have seen this, underwriters know and understand what the numbers should be. And you should know and understand what those numbers should be. And if those numbers aren't where an underwriter would expect it to be, just have an example or
yeah,
give a reason.
The reason why. At what level do underwriters require financial statements?
Generally not before 10 units. And really, for the most part, what we're seeing is probably 25 units and up.
How about, we hear a lot about credit scoring. And as we know, some of our people who are writing a lot of this business, in fact, the entity that makes the most filings based a lot of their premium on the individual credit scoring, although they only write usually 1 or 2 units as their base thing. What's your thought about credit scoring?
The jury's still out, to be honest with you. You know, it seems to work for the one company. They do get off an awful lot of risk after they get on it. So I'm not sure about that. You know, the idea behind credit scoring is whether somebody's going to be responsible, whether somebody pays their bills, you know, is it somebody you want to insure? People do it on the private passenger side. We're seeing more and more companies base private passenger auto numbers on credit scoring.
I thought the value of credit scoring was not can they pay the bills, but are they responsible?
And that's pretty much it, yeah.
Are they responsible? Where we talk about fuel surcharges, can and cannot be revenue depending on how you track those things. In fact, fuel surcharges often there, as you know, going back to CAB reporting, back early on, for you who were not paying attention in those first hours, you used to have to file your rates. And there is a federal formula that was used when the rates were required that you did not have to get federal approval to increase your rates if the cost of fuel went over X dollars.
Agreed.
And so anybody now with a fuel surcharge, something to negotiate, and it would be typically negotiated when they have a long-term contract with a shipper to take care of the variances over time. So that, and they could have other income in there, office rent, and this kind of stuff. So you have to worry about when you look at it, particularly the larger one. We mentioned earlier about ELDs and all this kind of stuff. And this is just a summation, Joe. You want to be accurate as possible. And so now we have this new tool, ELDs. What's your thoughts about it? What should underwriters, retail agents think about with ELDs?
I think that going forward, we're going to see more underwriters look for ELD data and basically look for a way to transfer the ELD data from the motor carrier to the insurance company's system. I think there's one market out there now that's currently using it, maybe.
It's a couple, three,
maybe,
but yeah, the people, again, the one we're talking about in Cleveland actually gives some credits if you give them access to the ELD information. I know a couple of them there that are trying to do that because it shows the actual miles. Mm-hmm. And the one thing, and we did involve this, Joe, back when the COVID hit, we wrote a white paper about the information. Now my truck's not being used. Mm-hmm. Can I get credit? And one of the things we suggested is, since the ELDs are vehicle VIN number specific, mm-hmm. that if they show the ELD records of that unit, then you can comfortably feel, well, they don't have the loads anymore because of COVID, and we'll give some consideration for reductions in premium, parking or something period of time, where before we wouldn't allow that unless they sold it. So this is something you can use. And a lot of underwriters don't realize that it is vehicle specific.
Yeah, and I think underwriters, the ELD side is kind of, we're just scratching the surface, because ELDs can provide a whole lot more information than just the state mileage.
Yeah, it can hard braking, the things of the EMC, which is electronic control monitors in the engines, and report that actually it ties into electronic control modular. So instance, how much can it capture out of that is the question. What can have those kind of things. So I think this is a new technology. What's word, Joe? Data is driving everything anymore.
That is king.
And this is a new source of data that we're just now tapping.
Exactly.
For underwriting and pricing. The concern we have with drivers is how often they can drive. They can drive 11 hours and work 14. Short haul is now can go 16, I think, and 13 or something like that. It's a little more for the short haul. Then they must stop 30 minutes, and that's still a ball here. They must rest 10 hours once they've done that. And then after they work 7 days or 60 hours, 8 days, 70 hours, they got to take 168 hours off. This is the regs and rules that you have here. So the most they can drive, then they can't drive again until you have the 34-hour restart. And then they'll be off duty this. And so this is the limiting. I always thought, Joe, is there any other business other than airlines and maybe railroad engineers that the government tells you when you have to rest and when you can work or not? There's a lot of debate about this, and actually the new rules that this came out, this is even more lenient than before here, because they're allowing some split berth sleepers. This allows them, and also some considerations for adverse weather or adverse road conditions, where they can go another couple hours as long as they reasonably document it and still not violate the regs and rules. And that's because the ELD, I was in a case, or got involved, or heard of a case, excuse me, I wasn't involved in it, in Orlando, where actually the plaintiff's attorneys were saying that the paper logs were comic books. The song, that the caravan song that we all have, that I like here, talks about swindle sheets. Those are paper logs, if you want to go back to what they were talking about, even on that song many years ago. And it was a lot of drivers' imagination. They don't have the imagination now. So the enforcement is different. It's accurate now, and you don't have as many not current, and even not as many as you have the long locations. But there is something called public conveyance that is all over the board. And so you need to look at it, underwriters, and you need to look at it as agents, and make sure your insurers understand how to properly do the electronic logs to make sure they're there. Now, the problem you have, Joe, when the truck has to stop for those 10 hours, and this is over, parking is a major problem.
And getting worse.
And getting worse. Where can they stop?
Most truck stops now, so many states have closed their rest areas, and the truck stops are being overcrowded. The ones that are open, COVID shut a lot of them down, which made things even worse. We're seeing more and more vehicles that are parked overnight along exit ramps or along single lane highways, and flashers or not flashers, you really are, exposing your unit on the road.
And you're more subject to theft, you're more subject to unit theft, cargo theft, work comps 24/7 because it's job related. So you need to worry about it because you got to have facilities to eat, to use the bathroom and this kind of stuff. And this is a real concern you have. And it all ties in because of the hours of service requirement. We've included a list here. Just get some thoughts from underwriting, Joe, of these various types of entities and which ones you would favor or not favor or need more information on.
You got all different things. When you start looking at dry vans, you're looking at quote unquote the general commodities haulers, and for the most part, that's probably the more common exposure that we see. There's a little bit less training, a little less technical than some of the others. Reefers, you have to be aware of your refrigerated unit.
Plus you got a time frame, so you might have to go faster, push them a little bit because you got something to spoil.
Exactly. And again, it's just a little bit different exposure. When you go to flatbeds, it's a totally different exposure when you start talking about what are you hauling? Are you hauling lumber? Are you hauling oversized equipment? Are you hauling concrete?
Will it fall off or not?
Size and weight issues. You've got tie down issues. Who's responsible for tying down the load? Are you picking up the trailer fully loaded and tied down? Are you responsible for taking care of that yourself? There's a lot of driver training involved. Then you go to tankers, and
I will make a note of tankers because I've used this as a question. Which is the most hazardous as far as an underwriting concern, milk or gasoline? And people don't realize that gasoline is easier to write and more people want to write than milk. And that's because of the configuration of the tanker. Do you have compartments in it, which limits I love to use the word sloshing around to about 2,200 gallons versus the 9,600 gallons that a milk has to have. So that's the subtleties that underwriters know and the agents need to understand these differences.
And tankers generally for milk are generally glass lined.
Yeah,
and if you
physical damage, you
cannot repair them.
Right, and you can't weld them because now you build up the surfaces that tend to build up bacteria and this kind of stuff. So this is the subtleties that you all need to pay attention here. And so just kind of on the next slide, Joe, is kind of summarize things that are important to you before we move over to CSA. Is the territory is important. You look at IFTAs, ALDs for that, who their customers are, and you can track that by the certificate insurances.
Yep.
And this will tell you where they have here. CAB and carrier software will give you a radius here. Years of operation, until they get about 3 years, you got a problem, do you not, Joe? Most of them, because they don't have any history.
Yeah, and if you look at the experience, most companies' experience show that new drivers, young drivers, or drivers that are operating a truck line themselves for the first time, the accident rate is much, much higher. And even if you have somebody that's been driving for 20 years, it's totally different when you're driving for somebody for 20 years and then all of a sudden it's your responsibility to get loads, to make sure everything's done on time, to pay the bills, to make sure the unit's maintained. There's a lot more concerns for somebody that's just going out on their own.
Number of units, most underwriters classify it in 2 ways. More information if they got more than 5 units, 10 required, but also coverage expects. As you know, symbol-wise, you're not going to get any auto until you get over 20, 25 power units. So the numbers become an important part of not only what you underwrite, but the coverage you're willing to offer.
Yeah, and the final thing, growth. It's funny because a lot of people, they go and they say, oh, this guy's going to grow from 2 units to 10 units, thinking that that's a positive thing to an underwriter. That's probably the scariest thing an underwriter can have because you don't have the controls in place. You're going from point A with very little controls needed to all of a sudden. I think you mentioned earlier in the day, now all of a sudden you got HR issues, you got hiring issues, you got driver screening issues, you got a whole
back to PSP,
back to PSP, a whole different level of concern.
let me suggest something to you as agent if your insured wants to grow this fast. Going back to economics and going back to how long the shipper takes to pay, unless you've got $12,000 to $15,000 worth of cash in the bank for every unit you put on, you cannot ride out the receivable cycle. So you got to ask your insurer, do you have a $10,000 to $12,000 cash? Are you able to front that money to the driver, to the fuel, to the owner operators, and this kind of stuff? And if you start factoring, then you've got a hole you can't dig out of, and that's factoring your receivables. So that's a concern you have growth. Not only there's a safety in place, but are they financially sound enough to do that? Joe, we talked about earlier, and we talked about CSA and this kind of stuff. Just very briefly, these are the inspections done on the highway, and it's a North American standard driver and vehicle inspection levels. Level 3 is the driver only. That takes about 10 or 15 minutes. And basically, is the driver have the right CDL, is a shipping, the right driver's license, an active CDL, do they have the right paperwork to haul the loads, and hours of service. Those are the three major things that the driver can be put out of service for on driver only. Walk around is the driver 3 plus the top of the truck. So there we look at tires, wheels, lights, load security for flatbeds, this windshields, and this kind of stuff. And that takes what, about 20, 30 minutes here. Both of those can be done usually on the road or on the side of the road. Level 1 is everything, including underneath the truck. And that can only be done at locations the driver feels safe. Inspection office feels safe. And it'll be the port of entries where they got barns or other things like that part of it. So you need to look at this just to realize how these levels are, because the results of those are then reported in CSA. And so that's the thing we talked about. That's why driving claims, that's why one of the main criteria for underwriting is CSA scores. CSA, our own road inspection, reflected in this SMS, the safety management system, that anyone can view. Anyone, agent, insured, shippers,
claimants,
and attorneys. That's what bothers me. CSA scores a reflection of the combination of the reports in the safety management system. Again, anyone can view that. The SMS system has the following statement. Percentage of motor carriers in the same safety event groups have a better basic scores than the on-road performance. This is what you rate. So if you have too high over the threshold, then now you're not operating like your peers are.
Exactly.
Why aren't you operating? So, and if the score is any basic that exceeds the threshold, then intervention. And when intervention happens, this is the culmination of intervention. So, you know, how many insured providers use CSA as a criteria for underwriting, Joe?
Every one of them. Every one of them. And that's the first thing that's looked at.
And so there's some with written rules, but even with no written rules, there's an intuition. There's part you don't do.
The 2 alerts rule is probably held by 75 to 80% of the insurance companies that insure motor carriers. If you've got 2 alerts, then it's going to be very difficult to get a policy written.
And so safety event groups they try to limit the 5 safety event groups, but they're just, the states vary too much. You got people who are in Indiana who get stopped for speeding all the time with events with people in Hawaii where there's not enough road to speed on. It's just not a real peer group. And so if you go to a different state, you can have a different score, even though you're operating the same. So this is the problem here. It's not a, you know, we can cuss the system, Joe, but it is the system.
Exactly. And it's what everybody looks at.
Yeah, everybody, including the court cases. So if your insurance say, well, it's not fair, they picked on me and that, you just got to say, we agree with you, but it's being used against you in court, and we can't afford to insure you when we know it's going to cost more dollars just because of these scores. When a threshold is exceeded, the motor carrier receives a warning letter. The warning letter helps the insured improve before or after the thresholds are exceeded. This is the thing in the warning letter, because it has on it, we urge you to take the warning letter seriously and improve your safety record. This is why agents who listen to us, as one of the things that we talk about at the foundation, is that you need to keep track of this and you need to be prepared when that warning letter comes to know when it comes and then help the insured improve before the underwriter looks at it, before it goes in the court case.
Agreed.
And this is the part here, and this is why we copied words out of the warning letter that says that. And because what the warning letter says is a review of Joe safety data shows a lack of compliance with the motor carrier's safety regulations. It's just that you, Joe's safety performance has fallen to an unacceptable level in certain areas. If that's written in front of a jury, how can that be?
You can't defend it.
You can't defend it. In fact, I was in a case in New England as an expert witness case where their expert actually quoted that as why they should pay more money. And this was a case where they were arguing that the driver had an hours of service violation when the driver had only worked 30 minutes that morning. This because of because they had an alert in that area. And I actually was going back and was able to find because of carrier software where that alert went down the next month. So I quoted the paragraph we just skipped over. They improved. That's what it says. This is what you have to be afraid of. We're worried about that being in court. So this is and this is what's being read in the court system. We urge you to take this warning letter seriously and improve your safety. This is what we need to focus on, Joe, and this is why we need to help. Readers should not draw any conclusions about a carrier's overall safety conditions simply based on the data displayed here. Unless the motor carrier has received an unsatisfactory safety under Part 387, which is the regs here, or has otherwise been put out of business, they can operate. This is, anytime you look at the scores, this is what it has, but nobody yet has the courage to get a court ruling that you can't use it in court. Everybody's just afraid of it.
And seriously, if you're just looking at risks that are unsatisfactory, there'll be very, very, very few that involved in claims.
Yeah, that part. The other thing we have is safety fitness determination. We already alluded to this earlier here. Those are when we went to show you the safety record where it shows there. Just realize how many people are unrated. In my opinion, unrated, if you've been this more than 2 years, is a positive, not a negative, because the government hasn't wanted to come visit you.
Exactly.
You need the first 2 years. You can go back and look at the roadside. The idea that 3% are conditional and 11% are only 11% satisfactory kind of blows everybody's mind. And these, again, are people with MC numbers and how many are unrated. And so unrating doesn't mean it's unsafe. That's the point we're trying to make here as both an underwriter and a retail agent. You go back to the actual roadside inspections to see how they have performed. Go ahead, Joe, talk to me here.
Whoa, reptile attorneys. I'm sure you've all heard of the reptile theory by now. If you have not, then basically what an attorney does is you may have an insured that did absolutely nothing wrong, was on the right side of the road, was observing the speed limit, was driving in a safe manner, and someone crossed the center lane and hit your insured head on. Did you pay anything to claim? No. I mean, were you liable? No. But what'll happen is if there's a blemish on the CSA score that says that there have been issues with that insured, then what happens? Then the attorney's going to go in front of a jury and say, this is an unsafe truck line. This truck line violates here, has incidences here, and totally take away from the actual accident itself and bring up other things that are outside of the total accident of the loss in order to make a point to get the jury to sway in their favor.
So they end up paying for their past sins,
exactly.
even though the accident that day was not caused by anything, the driver or mechanical failure or anything like that.
Exactly.
This is why we have to use CSA.
It's got to be a key under
because it's being used until they, my thought is, if everybody talks about tort reform, if they enforce, you can't use this data in court against the insureds, that would go a long ways to curb some of these unusual verdicts.
Agreed.
So go ahead, Joe, talk about that.
How CSA scores affect underwriting acceptance and pricing of risk. It's one of the key things. Like I said earlier, it's the first thing underwriters look at, and quite often accounts don't get past the underwriter's desk just based on the CSA score. They got the DOT number, they plug it in, they get a CAB report or carrier software report, or they just look on the safer system. And if you've got unacceptable scores, then what happens? They don't even look at the application. They don't look at the loss runs. They don't look at any of the history. It just gets declined outright.
So as a retail agent, you've got to have access to these scores. And the only way you do that is through one of these third-party providers.
And you really are doing your insured a disservice if you don't take advantage of that.
The next slide, I think we even talk a little bit more about this, Joe, if I'm not mistaken here. How does the insured view it? Well, they're more cavalier about it. They say they're not fair. They'll say I'm getting picked on, things like this. And we can't disagree with that. All we know is being used against us in court. And from a retail agent standpoint, it's being used against you insured and underwriting. And they're paying more for it. So this is the thing. Do they check their own scores? The larger ones do. The smaller ones don't.
Smaller ones don't really pay attention to it.
Yeah, and a lot of them can't get, most of the brokers and shippers use carrier 411 or one of these kind of things, and they can't get loads.
Yep.
This is the important part. So agents, you need to be prepared to help you insure for the scores.
Yes.
And there is some facilities through the people we just mentioned, the third-party providers that, and this is the one that crazy, Joe, I get upset nobody buys this, or not enough of it. For $10 a year per DOT number, you can get an email with your insurance scores every month. They change every month. You even can get them if they get within 10 points of an alert, which means you can take actions now before the underwriter looks at it at renewal time in a lot of cases here. Agents, you've got, if you're going to play in this marketplace, you've got to have these third-party providers send you the information so you understand CSA and you can address any problem before the underwriters consider it a problem. Don't you agree?
Agree completely.
So safety, SMS, CSA, users of verification information application, chameleon carriers. What's a chameleon carrier, Joe?
A chameleon carrier is somebody that has a real bad score. So they shut down company A and they start operating company B out of the same location for the most part with the same units and the same drivers.
And so that's another thing that you need to check beforehand because CAB and carrier software are going to show that.
And that's a big red flag to the underwriter.
Right, and that's if they exchange equipment, if there's more than one DOT number at the same location, if there's one more email address at the same location or a phone number.
Yep.
And some of that might not be legitimate. It might be broker, it might be a garage that they're not even insuring, but the underwriter's going to look at that. So you as an agent need to know that so you can explain it on the application to get it beyond Joe's desk.
Agreed. Okay, a lot of variables in general when an application comes in. When is CSA information reviewed? Right away. We talked about that before. It's probably the initial screening, and a lot of times underwriters don't even see it. It comes to an assistant's desk or a processor.
They
check the score, and all of a sudden, bam! If it's got 2 alerts, you just automatically send declination out. Are there any absolutes as to what is acceptable and what is not? Like I said earlier, 2 alerts is pretty big number. If you're exceeding your out of service numbers across the board, that's going to get you kicked out too. But you know, again, if you know what the story is going in and you've got a good explanation and a good cover letter and a good story to tell about an insured, you've got a chance. If not, then there are 1 or 2 markets out there that'll write it, but you're going to pay a whole lot of money for your insurance coverage.
I agree. This is one of my pet peeves. I've actually got an article that some other organization wrote explaining MCS 90s, and they called them a fouling. Folks, it's not a fouling. It is an endorsement attached to the policy. So please never call a 91X a fouling. It is proven financial responsibility, but it's not sent anywhere, and it's only getting looked at. It's when the officer comes, knocks on your insured door, and says, "I'm here to help you," and then they want to look at this. So we're going to spend this last hour, Joe, talking about the financial responsibility requirements, because this is what the insured has to have so they can operate. It's like any risk that, or any business you might write, insurance is not one of their more favorable things, but in the for-hire interstate motor carriers, insurance is actually a requirement. That makes them a buyer that is motivated not by, I want to buy it, but I have to buy it. So this is the part we have here. So motor carriers, for-hire and private, obtain DOT number. We went through that in the first hour. The information on safer. But in addition to the DOT number, an MC information is in license and insurance. And that is when they're hauling processed goods of others in interstate commerce. When they're hauling pickles instead of cucumbers. Back to my father's thing. Currently, the federal government requires motor carriers to gain from them permission. We call it authority. It's really just a permission to operate, the rights to operate, to haul certain property, not owned, somebody else's property, that has been processed, while the property is in interstate or foreign commerce. That's the people who have to have a permission beforehand, and you obtain that by getting an MC number, which is a separate, it's a part of MAS stage A1, excuse me, you go forward. This is where you get that authority. And they cannot use that, meaning they cannot haul processed goods until the insurance carrier sends a certificate of insurance. It's called a 91X. This protects the public from all activities under the government authority to haul certain types of cargo, and only applies to the federal regulated trucks, motor carriers with the MC number. There is one other thing we point here, though, Joe, to complete the process that a lot of agents don't understand, and clearly a lot of insurers don't understand, is they must also have a processing agent. I've had a couple of cases that have called me up on the Ask Tommy and the foundation, said, well, my insurance got their MC number, the DOT number, they got the MC number, and we filed a proof of insurance, but their authority is still not active. What has happened is they have not selected a processing agent. A processing agent is just somebody or some post office box, really, in the town or the state that your insured operates in. And they recognize that the key word here is interstate commerce. So the motor carrier might have a crash in a state they're not domiciled in. And to proceed legal papers, they're saying you don't, citizens of this state, you don't have to go to the home state of the trucker. They got to have someone in this state that you can send papers to process it. So this is what a processing agent is. And that's the third element. DOT number, MC number, and processing agent. Then they can haul processed goods of others in interstate commerce. Mentioned earlier, Joe, when we talked about the webpage and the FMCSA webpage that we're going to quote from here, and this is where we quote from. BMC 91 or BMC 91X. This is public liability insurance. Motor carriers, freight forwarders, no non-vehicle operator can waive this. They have to have it. And you have the minimum limits of 750, 5 million to have it. Joe, what's the difference between 91 and 91X?
In 100 words or less.
You want me to answer?
Yeah, you can answer that one, Tommy.
We're going to talk about it a few minutes later. This happened in 1980. What happened in 1980?
Motor Carrier Act.
What did one of the things the Motor Carrier Act did?
Increase the limits.
Increase the limits. And at that point in time, what the 91 says is an insurance carrier who file a 91, you're liable for whatever the law requires you to pay.
Agreed.
And so what happened is when they went from 300,000 to 500 and eventually 750, was a gap there. Insurance carriers were not in position to make the filings. So the X allows it to be layered.
Mm-hmm.
And so now what you do with the X is you limit your exposure to whatever you say it is. And so please, carriers in out here, you don't want to use the 91. You want to use the 91X. That protects you for some unknowns here. So you want to make sure you do that. And this is the filing and this is the limit. There is a 91X also required for haulers of people. And that is if they have more than 15 seats, they have to have $5 million. If they have less than 15 seats, they have to have $1.5 million. The limits required there. The other thing they have to have a cargo filing. At least they used to have a cargo filing. This was a big thing. This went down in March 2011. There's still some motor carriers out there who have cargo filings.
Yep.
And actually they're a mute because the federal government void in all of them.
Mhm.
But by the same token, some lawyer might kind of jump on those things here. One of the reasons, the limit, $5,000, $10,000. So the only entity that has to have a cargo filing today is moving and storage companies.
Mhm.
And so they're a unique requirement, and that's the only one that there's additional layer of requirements on it for motor carriers. If you're hauling hazardous, if you're hauling people, or you're moving and storage, hauling personal goods of others in that company, then you have certain additional layers of coverage. There is a bond required for brokers and freight forwarders. That bond is a $75,000 bond. Joe, you specialize in writing brokers and all. Can you tell the people what that bond pays?
Not much. You know, they're required to have a bond, but in all honesty, Tommy, in all the time I've been writing freight brokers, I have not seen a bond called at once. And basically what you're doing is you are certifying as a freight broker that you've got insurance coverage to cover a cargo loss up until.
No.
I mess up?
Yep.
Go ahead.
The bond only pays the revenue of the trucker who hauled the load if the broker doesn't pay the revenue.
Amen. I'm sorry.
It's nothing but a payment bond.
Yep.
It only benefits the trucker who hauled the load. And the reason that this is all part of MAC 21 when it went from 10,000 to 75,000. This is why the shippers were here, because what was happening, Joe, is the trucker would haul the load that was given to them by the broker, that the shipper gave the broker the load to broker.
Mm-hmm.
And then the broker didn't pay the trucker. So then the trucker went and sued the shipper.
Instead of.
And the judge said, yes, shipper, you owe it. I don't care if you paid it to the broker, you owe it to the person who provided you the service. Mm-hmm. And so they had to pay twice. And so this is the emphasis back when MAC 21 went in effect about 10 years ago, to raise the limit from 10 to 75,000 to protect the shipper from having to pay twice to have a level of coverage of 75,000. So all it does is to pay the trucker who hauled the load if the broker doesn't pay it. And I never liked payment bonds. When my father, as you know, was a broker, they had a red book and a blue book, and they did the financial rating of those brokers, and just like you decide who you're going to do business with, you see if they're financially sound. Mm-hmm. But that's what it is. So the point I'm making here is just like Joe didn't understand all that part of it here. I didn't mean to embarrass you in that area, Joe, but this is what they don't know. So it's a requirement. You have to have it. The foundation, when the MAC 21 came in, we did start something that has a facility out of Miami that can do broker bonds based on credit scores. So you can call Beth and we can refer you to that source. We don't get anything out of it, but you can refer to that source. We thought that we needed to establish to somebody we know. We already talked about BSC03. Now, look at the MCS 90. The first thing I want to look at, Joe, on page 91, page 89, underline. What's that first word there?
Endorsement.
Not a filing. It's an endorsement added to a policy. And that's the requirement of the public liability required under and we see section 2930 of the Motor Carriers Act of 1980. That's the act that changed everything. We'll talk about a little more about that in a few minutes. But the point I'm making here, 2 points. You need to understand this because you got to meet these requirements, whether you write somebody hazardous or you're a broker or you have a moving and storage company. But the other thing is, this is also a source that you cannot get anywhere else except through the FMCA website. And so you might want to keep this record or go to that website to download some of these kind of requirements. That's the point also that we wanted to bring you actually a snapshot or a page shot of the regulation itself, just to show you how it's put in there. So we look at the certificate assurance sent to the FMCSA 91X. It's for hire hauling other property. The property being hauled wrong, they only get the DOT number. They might need MCS90 endorsement, but they don't get it. They will need MCS90 endorsement. They don't get the intent. If it's processed again, going from cucumbers to pickle, then they have to have the certificate of insurance is required to be sent, and it will help them, will allow them to obtain an MC number in addition to DOT number. And what that is proof of financial responsibility. It must be on file before they can operate. And by the way, if it's not on file, they can be fined up to $11,000 for hauling loads that they're not authorized or not registered to haul. So this is the penalty that the government can impose upon them. The filing 91X certificate of insurance. Joe, when you were sitting as a wholesaler and I was a retail agent, I sent tons of certificates out. And I'm sure as a wholesaler, as a market, you're asked to send certificates out on behalf of your insurance.
Mm-hmm.
Other than maybe getting looked at audit time or so they can load, did any of those certificates ever come back and make you pay because of the certificate or often?
No, the certificate of insurance really is just verifying that coverage is in place to whoever is requesting the certificate. You're not providing any coverage to them. It's just really a notification.
And this is no different here. It's not insurance. It's just proof there is coverage. And the only time that certificate ever becomes in place, Joe, is if there wasn't insurance.
Mm-hmm.
I did have a case one time when my daughter ran into something, a contractor ran into him, and they refused to pay. So I did go back and find out from the school. She actually from the school, working on the school property, who that was, and got a certificate, wrote them a letter, made them pay for my daughter. That's the only time that things like this come in place. So it's not insurance. The only purpose is protect the public. It does not protect the insured. It protects the public only. If no coverage in a policy, so the first thing you do, you turn the claim in, and the first thing the adjuster does is determine if there's what, Joe?
Coverage in place.
And that would be symbols, some driver requirements, some other exclusions that might come in place, liability. There are not many, but there could be a few, misrepresentation or not cooperation or some things like that. This could be. And so then they deny the claim.
Mm-hmm.
Now what you have out here is that the insurance carrier who made that 91X filing now might be obligated to pay a judgment later, mm-hmm. even though there's no coverage. This is where it comes in place here. The filing will have to protect the public from any damage claims caused by any auto. Mm-hmm. The motor carrier using a part of their business as a motor carrier using their authority. Here's the key part here, any auto. Joe, when we ended up the slide before, we talked about some insurance carriers write a specified auto policy, mm-hmm. which says that if the vehicle is not specified, then it will not raise to a covered auto. And if that vehicle is in a crash, we will not pay a claim.
Agreed.
This is the most obviously gap in coverage mm-hmm. in this area. As an underwriter, what extent do you try to do to make sure that all the vehicles insured operates are on the policy?
Well, there's a lot of different things that you do. I mean, you start out just by verifying with the sources that we discussed earlier. You got your application with a number of units. They're required to add the units. If they do, find inspections. You can look and find VIN numbers at inspections. Pretty much what you have to do is you have to have hired and non-owned auto coverage on the policy so that should there be an incident like this and the vehicle isn't covered, then you at least have some recourse to collect at audit time.
So what Joe's doing is this verifying, just to remind you of what we talked about before. This is where we show you the inspection shows the VIN numbers. Mm-hmm. And this is where we say retail agents, you need to go back at least 3 months, if not 6 months, to look at all the vehicles that have been inspected under your insurance DOT number, because the underwriter is going to do that. Mm-hmm. And if that unit is not on the list that you ask for coverage for, the underwriter wants to know why.
Yeah, and in many cases, it may be a substitute unit. It may be a unit that's been added just because an extra load from one of their shippers came in and
it hasn't been inspected yet.
It hasn't been inspected yet. But if you see a unit that comes up regularly and a driver that comes up regularly under inspections for this insured, and it's not on the policy, the question is why?
Then once they write the policy, these same insurance carriers monitor those VIN numbers during the policy term.
Yes, they do.
And if they sign one there, you get a letter back and say,
You have misrepresented number of units. And in many cases, you just send notice of cancellation for not following policy conditions.
right, or you just go ahead and start charging for
Or
it.
you start charging for it.
Because if it's under hired auto, and here again, remember early on, we talked about one of the problems that we have writing for hire motor carriers is when they use owner operators.
Exactly.
And that's where hired auto comes in place, is owner operators. We know most of the time about our own units. It's the ones they don't own, owner operators that get on and off the policy so often. And that is an auditable policy.
Mhm.
In fact, I've been in 2 cases audited, one up in New England, and during the winter I charge more. And that they assigned risk and they misunderstood brokers and they sent the insured a bill under hired auto, if any, for $1,400,000.
How many units were on the policy?
Well, one unit, but it was a broker confusion. They didn't understand what brokers were. They didn't understand what exempt loads were. So I had to go up there and ended up not paying it, but I had to go up there and testify. The same thing, a coal hauler in Kentucky, where they aggregated 3 brothers and sent them $900,000. So even the hired auto, it's auditable.
Mhm.
And so even though it's now going to cover it, the insured will end up a lot of times having to pay a premium for those vehicles back later, which probably is the right way to do it because that's our business, premium for exposure. But most insurance carriers, and what you'll find this, if it's done right, most of the time is higher auto rate per 100 or per 1,000 of receipt is usually 1.25 to 1.5 times more expensive than if you schedule it on the policy.
Mhm.
Just so you don't pay for it in a hired auto because that is an unknown. But this is the important part here is that the words any auto, this is why underwriters bend over backwards to make sure they're insuring all the autos going in, they police it, and as agent, you need to respect that and realize there's no way you can hide autos. That just can't be done anymore. So the federal requirements, they take a DOT number and then they, who they are and what they operate, they pay a uniform carrier registration fee, as we talked about before. And then they get the MC number, and we find out that in license and insurance.
Exactly.
And then when you see that HTML, if you click on that,
Yeah, which we can't right now.
next page, this tells you who they are and what kind of authority they have. And then also the bottom line is the insurance required and insurance on file. This is where a couple of things happen. You got 3 classifications: common, contract, and broker. First thing is, Joe, if they had broker's authority and common authority as an underwriter, what are you going to do?
I would decline the risk.
You're going to run from it. Unless they got 1,000 units, they're going to pay you a lot of dollars to sue the
That's
first
another story.
That's another story. Folks, if you see they have brokers, active transportation, even common or contract, and brokerage, you're not going to get it written in this marketplace, or it's going to be tough to get written. So you want to separate their broker's authority from the operating authority.
Always.
Joe, would you think this is a common carrier or a contract carrier?
It's a common carrier because it's got active authority.
They say that,
Well,
but in reality, they're probably a contract carrier.
America Fresh LLC, you're right. I didn't look at the name, but it's probably on their
The
own.
only really people who are common carriers are LTL, moving and storage, maybe some tanker operations where they haul out of the same thing. Meaning that when you look at the truck as full load for one customer, that's usually on a contract.
Okay.
If it's nuts load, then that's the common. And here's the big difference, folks, is that they didn't know, and today we don't care. Previous to 2011, we did care because a common carrier had to have a cargo filing, a contract carrier did not. And so we recommended people not to have a common unless they're truly LTL. Today, there's no insurance differences except for moving and storage, and so it's no real big deal. The other thing you look at here, insurance required. I have no idea about this risk, and we don't know this, but would you not guess that they have $1 million?
Yes,
But they only put on the filing what?
750,000
Because that's all that is
required.
required. And so you got to explain to the insured, the only purpose of 91X filing is so they can operate legally. They don't come in play when there's a crash. When they come in and play when there's a crash, it's the policy limits to pay. And as long as it's covered in the policy, they got the full benefit for the full $1 million, including defense and everything else. The only time it comes in play is when there is no coverage. Now what happens is insurance companies limit their exposure to 750
50 instead of the $1 million.
and the insured has limited their reimbursement provision to that part of it, even though realistically they might be responsible for the whole $1 million, because even without insurance in excess, that's a whole different world. But you need to explain to your insureds and to some of their shippers that this doesn't provide any benefit to them. It only protects the public. It doesn't give any defense here. The only purpose of it is to get legal. They need a certificate of insurance from an agent that shows the actual limits on the policy to determine who to do business with.
Yeah, and we get a lot of questions that come back when a filing is made by an insurance company and it's only 750, and the question will come back from the agent and the insured saying, but I've got $1 million worth of coverage on my policy and you only have 750 on my filing. The insurance company is really just going to put what is required, as Tommy explained earlier.
We also can look at the back in license insurance on the next page. Again, this is who made the insurance filing. Again, this is the effective date. Most people think it's the expiration date would be a year after that. So when you ask for X dates for any lead services, they tell you a year after they file it, which might or might not be the actual expiration date, because not every carrier changes it every month. But this tells you actually who their current insurance carrier is. Again, forget these dates. We're using older examples in the book, just so we don't redo them. Go ahead, Joe.
No, but, and this is important because it's always good to verify who's currently writing the policy so you can match it up with loss runs. It's also good to know who your competition is, and if you know somebody's pricing is considerably lower than the marketplace, you might want to pass on the risk.
Or you might want to try to get a plant with that market. If you're a retail agent, remember who we're talking about here?
Absolutely right.
You might want to find it. And talk about previous loss runs, because you can go and look at their previous insurance carriers. And this is when they've had authority. And it goes back in authority. And my concern here, Joe, with that authority, when it's been revoked those many times, it's usually revoked because of the insurance filings.
Exactly.
And so you worry about a payment plan.
Yeah, because normally that's when you see something like this, you've got somebody that's premium finance, their risk, missed the payment, got a cancellation. The filing gets canceled, then they make the payment, it gets reinstated, and it's just a vicious cycle.
The next page, we actually can now go back to their last 5 years history of insurance. And so, Joe, this will let them match up the loss runs. Would it not?
Yeah, and it'll also say, give you an idea whether it's a loyal insured, whether it's somebody that's going to stay with the same carrier, or we've seen some of these where you have a different insurance carrier every year, and most underwriters are going to look at that and say, you know, if I have a not so good year, this guy's just going to go and move to somebody else, and I'll never recoup my dollars. So in many cases, if you see somebody, unless there's a good reason for it, and occasionally there are good reasons for it, but not too many. Yeah.
Go ahead, I'm sorry.
I was going to say, you know, sometimes you'll get an insurance company's appetite changes and they get out of the business. And sometimes as a result, when somebody gets out of the business, they get placed with somebody quickly just to make sure that the insured can operate. And then they actually find the market that they want to be with. So you could have multiple carriers in a 12 or 24 month period, and there'd be a good reason for it. But then that's one of those things that the agent really needs to explain going in.
Don't worry about replace and cancel, because we'll talk about that in a minute. That's just when it's moved. There's 2 ways that have been done on that part, and we'll share that with you when we look at the cancellation. But notice the thing that Joe's talking about, notice the dates. If there's too many in a year or 2 year term, then you know there's might be a public problem or a lack of loyalty. So that's the concern you have. Here's the BMC 91X, Joe. This is the introduction level. You have the DOT number and the date it's received. The next line is the important part of it. This is where the X here, this is where you lay your security. And this, you put the check there and you put the 750. And then if it was needed $1 million, you might have 250 in excess of 750, or it could be $1 million here, and then you have 4X of 1. But that's where that provision where it can be layered is why you have the X there, and this allows it to be layered. This is the prevailing paragraph, and we're going to look at 3 things in this paragraph. And you just bear with me here, and I know you all have the outline. Hopefully you're tracking me with outline as well as, or us as well as here. But it says policy of public liability, bodily injury, damage, insured by insurance company identified in the case of this policy qualified to make the filing. To be qualified to make the filing, you have to be an admitted carrier in some state, not necessarily the state that you're writing the business in. To determine to write primary auto liability, admitted or not admitted, Joe, is not the Department of Insurance, the Department of Motor Vehicles.
Exactly.
They determine what can be accepted as financial responsibility. How you write admitted or not admitted is the Department of Insurance. And I was actually with the granddaughters with somebody from Colorado up on the Fuscus Island the other day, and they were talking about that crash in California and Colorado. We remember where the tanker went down and burned up. It actually happened within a few miles of these people's houses. And this is a Texas risk, and we were able to go back and see that that risk was written with Lloyd's of London, that part of it here, which would be the 750. Well, Lloyd's would have written it because Texas laws have written it not admitted, but Lloyd's is admitted today in Kentucky and Illinois. Yep. Now they are going to quit writing admitted paper, and so eventually Lloyd's would not be able to make a 91S filing once they got rid of all their admitted paper. But this is here, even though they're not admitted in Texas, because Texas allows them to write not admitted. And so does, by the way, California, Louisiana, and even Florida. So the big states aren't required always to write admitted paper. But this is where you have it. That's what the word qualified is. If you look about 3 lines down, and you'll see that the MCS 90 must be attached to the policy. That's 4 lines down the middle. So anytime you write a 91S filing, you tell the government that there's an MCS 90 attached to the policy. I recommend not lying to the government, except maybe March 15th or April 15th, I mean, Joe, every now and then, to get very imaginative here. And even the point here, and I had many years ago, there was a wholesaler up in New England, up in the Northwest that was writing 91Xs, but not putting MCS 90s on it. And I thought that was the worst case scenario, because the court's going to interpret there's an MCS 90 on it, but now since there's not one, you don't get your reimbursement provision. So this part here, and those are the 2 wrinkles that are important here to us. But then the one that actually causes us is 2 lines down right before that break. You see here, vehicles are specifically described in the policy or not, we must respond. The liability of the company, this is the insurance company makes a filing, extends to all losses and damages, injuries or death occurring within the authority granted to the insured by the FMCSA, Safety Administration, or elsewhere. So what that says is, even if you have no coverage, you got to pay the price.
Tommy, I have a question for you, and one that I'm not sure whether you've ever seen or not. You write a commercial truck policy, and you do a motor carrier filing, and you've got private passenger autos on that policy. Are they covered under the policy too?
The answer to that question is no, because the MCS 90 only attaches the vehicle 10,000 GVW or larger. And there's actually a case out of Texas, and we're not there yet. That's the next one here, because this refers to that law that they'd be liable for. There's actually a pickup truck that the fleet had. In this case, it wasn't private passenger, it was a business truck used by the fleet, but it was less than 10,000 GVW, and the court said, no, you don't have to pay because the vehicle is less than 10,000 GVW.
You see, I ended up having to argue with a number of insurance companies over my career because they didn't want to do a filing on a policy if there was
Private passenger.
private passenger autos on it, and basically went through the same thing that you explained to me, and they just didn't buy it. It wasn't in their underwriting guidelines.
There is one other thing here. This is a continuous policy.
Mhm.
Notice of cancellation, the endorsement described herein may not be canceled or withdrawn without notice.
Yep.
And this is a big discussion point, Joe. And so first off, this is kind of a misnomer because under rules, there's two ways to get rid of this. The first way is if a new certificate is filed in the same name and the same limit as the old one, the old one is canceled by replacement. So it's no longer there. Or you decide this. You have a number of insurance companies who, because of this wording, and you have to give the notice, which requires 30 days plus mailing time, which is what it says down here, 30 days plus mailing, which now it's done electronically, so it's 31 days. How many of your insurance companies cancel the filings every year?
More than not.
Well, not as many as they used to, but they still do.
They still do. In the past, it used to be 95 to 100%.
Yeah.
Now, as a result of, well, probably technology more than anything else.
Where I was talking about.
Well, you talking about.
You and I had our discussion you and I had in Minnesota, 35 years ago?
That's about right. Well, we were canceling everything because we had a loss that we ended up paying a claim on. And supposedly the policy was replaced, and it's a long story, but the long and short of it is now with technology and the ability to make the filings electronically where you don't have that lag in the mail, it seems to help things a little bit. You'd be surprised though, the number of companies that still have filings outstanding that are no longer writing transportation insurance.
Well, that would be, yeah. We have a white paper on our website that addresses this. And the point I'm trying to make here is, as a retail agent, one of the things you need to know is your insurer going to cancel the filing every year or not, so you can alert the insurer.
Mm-hmm.
The second thing you want to know as an insurance provider, look, you've been running this risk for 10 months.
Mm-hmm.
They made the payments. If you intend to renew, then you're taking the one thing away that you have advantage over your competitor, as you've got everything in place. So you need to think twice about canceling if you want to offer renewal. If you're not going to offer renewal or you're going to double the price, then cancel it. I mean, so clearly hear me, I'm not saying that, but if you want to keep it, you want to have every hedge involved in that part of it. Because think about it, Joe, how many risks that you have been successfully insuring for a year? Other than COVID and the shutdown of the industry in 2005, I mean, it's always an anomaly. It's going uninsured the next year.
No.
Yeah, and they can't get loans because there's no certificate out there.
Mm-hmm.
So then what is the exposure then? Because if they make the renewal and they buy a policy somewhere else, now you have a crash. Does a policy pay or the filing pay?
The policy pays.
The policy pays. So even though the filing's not there, if they have coverage at the time and at least pay the $750, you're not going to have any exposure under your filing for not being canceled because of the case. So, is it worthwhile not to?
No. And like I said, the incident we had before was prior to electronic filing.
And also the law and this kind of stuff. I'm quoting a new law involved in this thing that happened in this. And so, agent, you need to find out. You need to act. If the agent doesn't send the information in, then cancel it, But go in and say, the good risk, we're going to keep it. Please let us know about the cancellation. Try not to. And then if they're going to cancel it, go to the insurer that says, insured, the government makes them do it. Quote here, we still love you. Once you give us an order, we'll put it back in place. But I will tell you, Joe, when we did that white paper, there were at least 3 instances where they failed to do it back. And the wholesaler and the company paid $5,000 to $8,000 because they lost loads because the authority had been revoked because they canceled it. Mm-hmm. And so that's the downside for not doing it. And so that's the point that I want to point out here. The next slide just talks about the limits. Basic limit $750, $5 million. folks, your insurers are not going to inadvertently pick up needing 5 million. That's the shipper's going to make them have the 5 million. But the big difference is between 750 and $1 million.
Mhm.
Big discussion, 8, 9 years ago about gasoline hauling.
Yep.
They require $1 million because of what's in the vehicle, and part of it would be 5 million here. Excuse me, would be 750. I had a case where and this actually reported to us that they complained here because they ended up saying they're hauling 5 cans of rubbing alcohol. And that's
55-gallon drums or just?
No, that's rubbing alcohol. And because they're hauling, because it says any quantity.
Yep.
Then they said you need $1 million for that. So it's kind of in the gray area, this part of it, in this level. I will tell you this, where the motor carrier decides what the limits have to be paid is required is 2 places. The first place is based on that going back to the 150, what they say they're hauling on the 150 was the hash count. This is where that limit required is set. The only time that's enforced is if the DOT officer comes knocks on your door and actually sees what you're hauling. That's the only time it's policed. And what, Joe, 15% of our motor carriers actually get inspected. If that many. So it's not that in place on that. Sorry. So this is the limits that you have to have. The key word there will show you is that any quantity, because there is a gap between 750 and $1 million.
And in all honesty, Tommy, I see very, 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 very few requests for 750 limits, whether that's required limit or not. Most policies have $1 million.
Yeah, and this is where the filing goes. This is where the 750 filing.
Exactly.
So in summation, the 91X is a certificate of insurance. It's not insurance.
Mhm.
The name of the certificate must be the name and license and insurance. That's the name the government knows about.
It might not be the name on the policy.
Right. And in that case, you want to make sure the name on the policy is the entity that owns the assets, not the name the filing in, because that's who the policy is going to respond to.
Mm-hmm.
Then you'll figure out how to do the filing here. And my suggestion, Joe, is that, if it says Tommy Ruke doing business with Ruke Transport Inc., you don't want to ever put an individual name in the insured line, but I'll make a filing in that name as long as that's the only trucking company I have it, and have Ruke Transportation Inc. as the name on the policy. So you got to walk through that here. This is to complete the process of being legal to haul processed goods of others in interstate commerce. And so we talk here, it's not necessarily the name on the policy. So you got to work those things out to make sure that they correspond. So the limit 91X required is reflecting license insurance. That's not the limit of the policy. That's based on the 150 information. The certificate of insurance is based on. Must have an endorsement, MCS 90 attached to it, which we're going to get to in a minute. And again, it protects the public, whether the unit being operated under the motor carrier's authority for specified in the policy or not.
Correct.
That's the key word. The continuous proof of financial responsibility protects the public until cancellation by the insurance company or replaced. This is the thing that we talked about, and that other provision here in 30 days plus mailing. So the 91X becomes involved in a case when there's no coverage. If coverage, the public still is protected by the insurance carrier payment of the judgment against the insured. But if the insurance carrier can seek reimbursement. So there's no coverage. That's the problem here. To keep the authority active, they must have a 91X, which is continuous until canceled. If canceled, then authority gets revoked. That goes back to that slide that we showed you where all that authority got revoked.
I can honestly say though, Tommy, trying to collect from a motor carrier, if based on a filing is pretty difficult unless you want to own mortgages on some trucks.
Yeah, and I have and we'll talk a little more about that in the MCS 90, but I think we need to attempt to anyway, Joe, just to send a message.
I agree.
If not, you're giving
free
coverage.
Yep.
And so this. Motor Carriers Act of 80, MCS 90 already did. Its license requirement, it now costs us $300, and that will haul goods that are consumer goods anywhere. So this allows you to do that. And then this is where they raised the limit from 300,000 to 500,000 to 750, and this was effective 1/1/1985. Folks, you're going to hear a lot about that in the next three months, because 750 using inflation from these 35 years would be Is it 35 years?
Mhm.
35 years would be 3.4 million.
About that.
And so since they haven't been raised since then, there have been increases to propose that. It has been shut down a couple of times. In fact, some of you might not realize this, but the government went through this process back in Obama era in the MAP 21 process to a study, and they found there was no need to.
Mm-hmm.
I actually wrote a white paper about that need too, but we're going to hear it again. There's pressure there. For you who do not know it, the infrastructure bill that the House approved was favorable until they attached an amendment to raise the limit. Then the the trucking industry then defeated the infrastructure bill. And when it happens again, will it be raised again? Hopefully not, but you're going to hear this. And today's with the hard market, Joe, what's that going to do to the market?
Oh, it'll shrink to practically nothing. When you look at insurance carriers that insured truckers, motor carriers for the last 10 years, they really haven't paid any money. And now with nuclear judgments, we're going to say we're going to raise the limits to $1 to $2 to $3 to $5 million. Excess insurance especially on the small guys, is almost non-existent in the marketplace now. It's even costly and difficult to get for the larger insureds. It really will put the 1 to 10 guys out of business.
Right. That's the thing here. The next item here, the new financial responsibility requirement applies to not only for-hire hauling consumer goods, but all people with DOT numbers and some private carriers. Mm-hmm. And so you have my father hauling cucumbers, would not need a 91X filing, but he would have needed an MCS 90 attached to his policy.
Correct.
That's the point that we have here, even without that. And I've had a number of companies say, well, they don't have an MC number, we don't have to make a filing, so we don't have to put MCS 9 on the policy. Again, I worry about underwriters that don't understand this process. In fact, Joe, if my agent knew enough to ask for MCS 90 on a gravel hauler, that's the agent I want to write, because they know what they're doing business with. And this is the thing, and we've been involved in it. If you're a private carrier, you do not have to meet the requirement unless you're hauling something hazardous in interstate commerce, crossing state lines.
Right.
As long as you're hauling intrastate, unless you're hauling in bulk, which is 1,000 pounds of a solid or 35 pounds of a liquid, then you have to worry about it. But that's who needs the MCS 90. Adding a requirement to meet the environmental. This is what MCS 90 did, and that is the environmental restoration. This was pollution cleanup. That was what was added to it. And the financial responsibility requirement applies to all units, 10,000 GVW or larger, not smaller. That's any unit with 6 tires or more, used by the motor carrier for hire or private. So that's the concern you have there. Requires all for hire and private motor carriers that transport any quantity of hazardous items, interstate commerce, and bulk, to have an MCS 90 attached to the policy with the proper limits, which would be $750 for non-hazardous, $1 million for, and so any private carrier would have to have at least $1 million, because they're hauling gasoline or something that's hazardous, and then you have these $5 million. The Motor Carriers Act also was the first regulation that applied to exempt as well as private carriers.
Sure.
Before that, the only people that were worried about were people with MC numbers who had authority to haul processed goods. This is the first regulation that posed financial responsibility or additional insurance requirements on private and interstate exempt haulers.
And it made sense.
Yeah, I mean, I never understood, Joe, when my father was hauling pickles, he had a 91X. When we was hauling cucumbers, he didn't have to. And when Vlasic was hauling their own cucumbers, they didn't have to. So why pick on one entity here?
Yeah. I mean, it's the same exposure.
Yeah, and that's part. So why just look at this one entity? So it's forced by the new financial responsibility here is that they look at an inspection time to see if they have it now FMCSA, and if they do not have it, they can be fined $11,000 a day.
I wonder where they came up with the 11,000.
It used to be 10. They just raised 1,000 about 10 years ago. So let's look at the last few minutes we have here. Let's look at here. MCS 9 is required for both exempt and non-exempt for-hire motor carrier to operate interstate commerce and private. The 91X filing with the FMCA places compliance with the Motor Carriers Act of 80. The insurer agrees to pay to protect the public, even if no coverage in the policy. yet there's a reimbursement provision. That's the key, which says that even if we have to pay, there's no coverage in the policy, you agree to reimburse us. And that's the downside to it. It's suretyship, Joe. It's not coverage. It applies to the insured, that the motor carrier only, not any other motor carrier or driver. I had a case where they sued the owner operator, but forget to sue the motor carrier. And I was looking at it to find out if they did. I said, what makes a difference? You got to pay them? No, they only sued the independent contractor, not the motor carrier. So if it's not a covered auto, we don't have to respond. That's malpractice on the plaintiff's side. God bless them. Hope they have more than that. Anyway, there's no duty to defend MCS 90. That's a big thing. There might be duty to defend in the policy. So once the we determine there's no coverage, then there's no longer any defense in it.
Yep.
Claims for reimbursement, it's the carrier's decision, but we strongly recommend you do it. You send a message. Joe, you might not get $1 million, but you might get 300,000. You might put them out of business.
Well, I think most of the cases that I've seen, you end up putting the motor carrier out of business.
Well,
and that's fine.
Now with the chameleon carrier, they can't get back in business because they cheated us. So
Yep.
we need to do this. And it's a 36 days notice that we have to do the part. For hire interstate motor carriers, they must obtain, Joe, go through this summation real quick.
Yeah, for hire interstate motor carriers must obtain a DOT. Information is found in safer for all the world to see. Application to underwriter must match. We can't stress that enough. Everybody except raw goods has have a filing, but need the MCS 90 endorsement to the policy. Processed goods, regulated motor carrier number. You got to make the 91X filing furnished to the FMCSA.
That's so they can operate. That's the first thing you have to do.
MCS 90 we talked about is an endorsement attached to the policy in the insurance office and available at inspection. It does not have to be filed with the federal government. The MCS 90 is not insurance. It provides no coverage to the insured motor carrier. It only protects the public. If no coverage, it pays because of the MCS 90 or 91X, and the insurance company can seek reimbursement from the insured. Underwriting considerates. All units motor carrier uses, owns, or leases have to let the underwriter know. Operations under the DOT number, units with 10,001 gross vehicle weight or larger must be covered autos. Serial numbers of units are found multiple places. Make sure that you have all the units on the policy and a current driver list. ELD information we talked about with respects to the information it provides with as far as mileage by state, but there's also a plethora of other information that is available but hasn't been mined at this time.
And we hope you all enjoyed this and learned something about it. I enjoyed being with you, Joe. Thank you.
Tommy enjoyed it too. If you have any questions, please send an email to MCIEF@mcief.org. And thanks for your time.